All right. Oh, good afternoon, everybody. My name is Dave Cadu. I am going to be the lead facilitator for today's session. It's great to see everybody today. We'll just jump right in and welcome you to the fundamentals of tax-exempt bonds. I'd like to introduce my panelists at this time. We've got a pretty good crew here. So my name is Dave Cadu. I'm the Senior Director of Public Housing Initiatives here at California Housing Partnership. The partnership is a nonprofit consulting organization that provides technical assistance on policy and financial consulting issues to nonprofits and public agencies throughout the state of California. And as usual, we're thrilled to be leading this session here at Housing California. And next, I'd like to ask Claire to introduce herself.
Hi, everyone. My name is Claire Parisa, and I also work at the California Housing Partnership. I'm an Associate Director of Consulting Supervision. The Bond Institute is a special, wonderful endeavor that we have at Housing California every year. And you will come away from this session knowing so much more than you ever knew you needed to know about bonds, from structuring to SIDLAC, how to acquire bonds, and the 50% test. So I'm really looking forward to kind of diving deeper with everyone else today. Thanks.
Great, thank you, Claire. And next I'd like to ask one of my other colleagues, Tyann, to introduce herself.
Technical difficulties. Hi, Tyann Go, housing finance consultant at California Housing Partnership. Be here in the background, hoping to answer your questions as they come up.
Great, thank you so much. And next, our first panelist to present today will be from CMFA. Ben, would you like to say a little bit about yourself?
Sure. My name is Ben Barker. I'm with the California Municipal Finance Authority. I think this is my 10th year doing this panel, and every year is interesting and new questions come up, and I also feel like I learn something new every year. So it's very informative and kind of a fun panel, and encourage everybody to ask as many questions as they can during these next few hours we have together.
Great, thank you very much, Ben. And after Ben, we will be hearing from Ron. Ron?
Everyone, Ron Lee. I'm a partner at Jones Hall. We're a law firm that specializes in municipal bonds. This is my first year doing the panel, so I hope I can keep up.
Great, thank you so much, Ron. Appreciate you having you here. And last and absolutely not least, DC.
Hey, DC Navarrete, and I am a program manager at SIDLAC. So everybody here probably knows what SIDLAC is, so I don't think that needs any explanation.
Great, thank you so much, DC. Okay, so I'm gonna go ahead and share the screen and start the presentation here in earnest. Just to go over our agenda real quick. So we've got three basic sections here. And as I noted, Ben and Ron are going to kick us off with sort of an overview of the tax-exempt bond program and, sort of more of the technical requirements. We'll break that up in the middle with an exercise where we talk about the 50% test, which is probably the most critical thing for folks to track during the course of construction when they do a 4% tax credit project with tax-exempt bonds. And finally, we'll go through the details of how you can get allocations of tax-exempt bonds and tax credits for your project. So we'll be talking with DC, going over changes to the regulations and the scoring system, and finally the new tiebreaker system that's come into play this year. So that's our basic agenda. In terms of ground rules, I think everybody is probably already on mute, so appreciate that. But please also try to, eliminate as many distractions as you can as you're going through this. This is not, it's not easy to do this type of session virtually. We appreciate everybody sticking with us, and just, as we go through this dense material, try to get as much out of as you can. For Q&A, should be a Q&A function, I believe, within Zoom. And feel free to ask questions whenever you feel comfortable. We will try to address those as we go. There will also be a general Q&A session after the presentation is done. And we've got a few polls. So to make sure that you've got the material, a handle on the material, we're going to check in with you a few times. We're not keeping track, of course, but just to help people focus on what we've learned today, we'll have a poll or two for you. And speaking of which, the next slide is our first poll question. So poll question number 1 is, what area of affordable housing are you mainly involved in? Please answer when you have a chance, and we'll go over the results here in a moment. All right, it looks like we've got most everybody squared away here. So looks like I hope you can see that up on your screen here. We've got a pretty robust cross section of folks here. We've got roughly half of you are from the development community, as on sponsor side. We've got about a quarter of us from public agencies or housing authorities. About 10% from investors and lenders, another 10% from other consulting environments or legal environments, and got one contractor or architect with us. So it's great to see such a wide variety of folks lined up here today. And just like that, we've got our second poll question of the day. Have you worked on a tax-exempt bond project before? All righty, looks like most everybody has weighed in here. And so we've got a pretty even split here, which is great. Looks like a 55-45 yes/no split on this question as well. So great to see a lot of newcomers here, and also great to see a lot of folks who've got a little bit of experience with this material. Okay, so with that, we'll go straight into the overview of tax-exempt bonds. And I think at this point, I will hand it off to Ben.
All right, thanks, Dave. So it looks like the slides have changed up a little bit this year, but I think what explains what we're doing is the very top line, fundamentally a mortgage loan with some technicalities. So as we get into the tax-exempt financing world and the bond world and trying to do affordable housing, we can get buried pretty quickly and get pretty cumbersome into the details and the minutia of what we're trying to do. But essentially, that's all we're doing is just getting a mortgage loan, something that is represented like a mortgage loan, and that mortgage loan gives us some free equity into financing an affordable housing project. And so a bond here is pretty much the same thing that you're looking at when you're financing a house, is we're just doing a bond financing, and that bond financing kicks off some tax credits, which acts as equity into your project. And so a bond is just a debt instrument. It's just a loan you're putting on something. In this case, the bond's tax exempt, and we'll get into that in a little bit more. In order to have tax exempt financing, you need to have that tax exempt financing be issued by a public agency, and housing bonds are one flavor. So we're going to go through one style of affordable housing projects or bond financing for this seminar. There's actually a lot of different types out there, but we'll cover just the ones with tax credits, kind of skip the rest. So let's go on to the next slide. All right. So what is a tax-exempt bond? It's the tax-exempt bond. First, let's go over what a bond Okay, so a bond, a loan, or a note. You'll see these throughout your time in this world. These will be changing. These three words will be used interchangeably. Typically, a note is something that's thought of between 1 and 9 months. A loan can be of maturity, and then a loan goes out a little bit further, and a bond is a little bit further out. They're also thought of as a loan is between you and one party, and a bond is money lent from a larger party with a lot of investors over to you. But in this case, when you're going through bond documents, you'll see these three terms used somewhat interchangeably. And there's reasons why, but we don't need to go into that, but it's just a little bit of background on the bond, loan and note. What the interesting part of this is the interest that is then repaid back to the bank. That's what the tax exempt comes from. So there's no taxes paid back. There's no taxes paid on the interest there. So the people that are going through and have to issue these notes is typically a governmental entity. This can come in many forms in the state of California. So it can come through the state, it can come through a county, a city, towns. You can have port authorities, hospital districts. You can have all other kinds of groups doing it, as well as agencies and joint powers authorities. There's a lot of different entities that can issue tax-exempt bonds. In this case, in their charters, they have to have information contained within the charter that allows them to do these things. But essentially, the groups that you're going to see most active in this space is going to be the state entity, CalHFA. You'll see a couple joint powers authorities, the CMFA and CSCDA, and CalPFA will be the JPAs that are in this space. And then you'll have a lot of cities and counties, and then housing authorities who will also be participating. You will have, to go along with this, there's a lot of technical requirements. So we're going to go into that in a little bit, but the technical requirements, you can leave that up, Dave, if you're going through that. Sorry, my face is covering, so I can't see this part on my screen. So the technical requirements are going to be the tax code that goes along with this being able to legally issue the bonds. There's a difference between tax-exempt bonds and a 501c3 bond. We'll get to that question here in 1 second. All right. Tax-exempt bonds typically produce lower interest rates than a regular mortgage would or a regular loan would. And they're also constrained by volume cap. So volume cap will go into, it's just the amount each state is allocated per year to do in bond allocation. So in this case, California is allowed to do about $4.3 billion in bond allocation per year. And along with that bond allocation, it generates the 4% low-income housing tax credits. So we had a question here. Let me see if we can go to it. Jenny asked, what's the difference between the tax-exempt bond, 501c3 entity bond? Is the 501 bond tax exempt also? Okay, so I think what we're asking is with tax exempt bonds, they fall under the tax code of private activity bonds. And the private activity bonds, the interest is tax exempt. And then in this case, we're asking is a 501c3, that also falls under a private activity bond. And those are also all tax exempt. So there's very few cases where you're going to have any taxable bonds in this scenario. You need tax exempt bonds with a bond allocation that will then generate the tax credits. So on the affordable housing space, generally the only time you're going to see taxable loans, if there are borrower requirements, if there's monies that need to be borrowed that don't qualify for tax exempt bonds. In those scenarios, you'll see taxable tails on those deals. So, but they'll also always have a tax exempt bond with the tax credits and then sometimes taxable tails. Hopefully I answered your question there. All right, so let's, you're welcome, Jenny. So let's go into a little bit more details on the 4% tax credits and what they are. But first, I think that the big thing to think about is that the volume cap, and we're going to go into SIDLAC and TCAC and what volume cap is and how it's allocated in a little bit. But we're going to go more into the generation of equity for the 4% low-income housing tax credits. If we want to skip to the next slide. All right, so the reason we're using bonds is really, the main reason we're using it is just to get the tax credits. So you can go out and just do a 501c3 bond alone and just do a financing alone. That happens all the time. But really, you need to get the bond allocation from this case and from SIDLAC. And by going out and getting bond allocation, it generates 4% tax credits. Those 4% tax credits are essentially free equity into your project. So the bonds that we're given make up 50 to 60%, sometimes more, of the total amount of the project costs. So generally have the tax credits will be worth 30 to 40% of that. And then you'll have some gap financing that you're going to need to fill. With the tax credit, there's certain tax code requirements and certain tests that need to be met. And that's the 50% test. So you need to use within your financing structure, your total borrowing needs to be 50% of all of the borrowing needs to come in the form of tax-exempt bonds. The remaining 50% can be made up of tax credits and other types of financing. Along with that, when you're typically talking about tax-exempt bonds, the interest on the bonds is much lower than interest on a market rate financing. So private activity bonds generally will have a lower yield of interest, as well as they can go out further on the maturity scale or further on maturity than a regular market rate loan can. And so with lower interest rates and longer maturities, and then generating tax credits, you're able to make a project that's financially feasible. All right, let's go ahead and skip. So what is the primary benefit of using tax-exempt bonds? Question. All right, we'll wait a few seconds to get our answer, see where everyone's at. I probably glanced over this part a little too quickly, but. Yeah, looks like everyone's taken this class before. So yes, the main reason we want to do go in for bond allocation is to be able to unlock the tax credits. Essentially, for your project, it's just free equity that your project won't have to pay taxes, and you're going to generate tax credits in the 4% form. And so you're able to go off and then sell these tax credits, which will give your project free equity. So very good for those to answer that. But also lower interest rates is also a right answer. Let's go on to the next question, the next section. I think we're on slide 17. There we go. All right, so taxes on bonds competitive. For the past 2 years, they have been competitive. Let's start back. We went through a long period of time. I think 2009 was the last period of time that they're competitive, and they were only really competitive for about 6 months of that year. And so we had been living with bond requirements and regulations that were really outdated because we didn't really contemplate the competition. So as we went into 18 and 19, when things got competitive, there's a lot of, a bigger need for the reviewing of the SIDLAC regulations and the revamping of the regulations. So the last few years, we've gone through quite a bit of regulation changes on how these deals have been scored and who gets to win and what's going on with them. But the bonds are now competitive, and I believe, at least through CMFA's pipeline, they'll be competitive for at least another couple of years that we can see in our pipeline. We have enough deals that would take up all the bond allocation for a few years. So I do think it's going to be quite some time before they go uncompetitive. if everything just remains the same. But each state has their own way of allocating bond allocation. In California, it goes under the treasurer's office, and then under the treasurer's office, there's two different sections. The first section is for the bonds that goes to the to CDLAC, California Debt Limit Allocation Committee. And what CDLAC does is they give the authority for issuers to use volume cap. And that volume cap is then designated to the issuer, and the issuer is allowed to use a certain amount of volume cap per issuance. So each state has a total amount of volume cap that's given to it each year, and it resets at the end of the year. If it's not used, it disappears. So they need to allocate the full amount. California typically runs about $4.3 billion of volume cap per year. And that is generally designated to affordable housing. There is a certain pot of money that then goes to exempt facility, or it can go to single family housing. But over the past 2 years, most of the money has gone towards affordable housing. So I think roughly 3.6 billion has gone towards affordable housing projects. And so the other side of that is TCAC, which is the Tax Credit Allocation Committee, that's also underneath the Treasurer's Office. They oversee the 9% tax credits and the 4% tax credits. So the 9% tax credits is a standalone allocation that does not include bonds. So when your project goes in for bond allocation, it's going to generate 4% tax credits. So we won't talk about the 9% too much in this, but we will be generating 4% tax credits with these projects. So let's go into what do we need to do to qualify to receive that to receive the volume cap? What do we need to do to get the bond allocation, and what are the minimum requirements? So the technical requirements. So if you look at on a macro scale, there's federal requirements, and then there's state requirements, and then sometimes there can even be local requirements. For instance, if you're building a new project and you're living maybe in the city of LA, you're going to have requirements there that are going to be overlapping that might require using prevailing wage or living wage ordinances. San Francisco and Sacramento, some of the other places have these other requirements in addition to what's required by the state, and then in addition to what's required by the federal. But the federal requirements are generally the most minimalistic requirements, that they're actually pretty straightforward on what's required to build affordable housing and what goes into it. So there's a minimum affordable requirement. We'll go into that in a second. Then we'll go into the issuance process, good versus bad cost, and the 50% test. So let's move into the federal requirements. And the federal requirements, you're looking at the tax law, it just says 20% of the units have to have 50% of area median income, or you get to choose 40% of the units at 60% area median income. Let's talk about those real quick. Generally, we don't see projects that do the minimum requirement in California. And the reason for that is because of what the more you use on the affordability level. If you're using 100% affordable, with these requirements, you're able to generate more tax credits. And so the more tax credits you're generating, the more free equity you're generating into your project, and the more your project becomes a feasible project and you're able to finance your project and start construction on it. But the minimum affordability is 20 at 50 or 40 at 60. And in addition to that, it's a 15-year affordable period on those. So when we were a few years ago, before I think this is 08, 09, CDLAC had affordability period out to 40 years. And then if you wanted to get additional points, when things got competitive, you could apply, and you could select to go 55 years for the affordability period. And that really, once we went through that affordable period in 08, or I think it was, 09, that 55 year was then imposed going forward. So there used to be a 40-year period. Now it's a 55-year period. So if you're looking at old projects to purchase or refinance or go through, you might have some really weird affordability periods if you're looking at pre-existing regulatory agreements. The regulatory agreement will outline what the affordability is within the project and for the project period of affordability. So, I get this question that comes up once in a while. Why does this have a 15-year? Why does it have a 30-year or a 40-year or a 55-year? But it really depended on if it was just a federal 501c3 transaction, if this was one of the first tax credit deals done in '86. Maybe this was done in the early 2000s. There was a 40-year, but most everything we're seeing has a 55-year on it, and especially everything now, as you're going through CIDLAC, has a 55-year regulatory period. In addition to that, you have to look at the rent levels, and the rent is set at 30% of income levels. So 30% of the income, maximum 30% of their income can go towards the projects. So the state agencies, CIDLAC and TCAC, impose additional affordability restrictions, and we can go on to that. I guess I skipped a little bit further out. Sorry about that. So yeah, if you just want to back up a slide real quick, we'll just go through this. So yeah, again, federal, 15 years for 50% occupancy. California is a 55-year minimum affordability. 50 years for projects based in Native American lands. I have done 500 projects and have never done a project on Native American lands, and didn't realize that that was even in the bond regulations. So that's the new thing I learned today. Dave, have you guys done any financial advisory work on any Native American lands?
We have not historically done a lot, but that's as part of trying to expand who we serve and make sure that everybody in the state has access to housing. That's actually something that we're starting to emphasize now and trying to do a little more work in that section. So hopefully we'll learn a little bit more about that here in the coming days.
I had a call from a tribe maybe 3 weeks ago, and they're exploring some affordable housing projects, and good to know. I didn't know that was a thing. Ron, as bond counsel, has Jones Hall done very many Native American projects? Just wondering.
I'm not aware of any multifamily housing.
Yeah, be interesting. It'd be good to see. I haven't seen it too often. So, all right. So we've gone over the macro issues again. All just to quickly kind of recap here. All we're doing is trying to get a mortgage so that we can build an affordable housing project. Typically, because the rent's restricted in an affordable housing project, your project's not going to pencil because you just have a regular old mortgage. So you need to have bonds that have lower interest rates, that are attractive to lenders and purchasers because they're tax exempt. And because you're getting that bond allocation, you're generating tax credits. Tax credits is going to give you that equity to go into your project. And then you'll also be able to probably be able to qualify for grants or other things that can kind of fill that gap in your financing. But to do that, there's a process that you need to hit. And this is a very important process. And we see projects get tripped up by not following this all the time. And it may be that the project was taken to maybe an issuer that doesn't issue bonds all the time. Maybe they aren't familiar with the updated CIDLAC regulations or just certain parts of the tax code, but they end up issuing the bonds. And the first part is your reimbursement or inducement resolution. You kind of see the reimbursement or inducement resolution used interchangeably. You see it a lot by, I guess, different bond councils that will, call it one or the other. But essentially, when you have a project, and this goes really for developers or even for city, county, or housing authorities, whenever someone approaches you with a project, you want to induce the project as soon as possible. And the reason is it really kind of starts the line in the sand or starts the clock on the process of taxes and financing. You can go back, and capture certain costs 60 days before the inducement resolution is approved. And so we'll go into what those good costs, bad costs are, and I'll have Ron cover that in a little bit. But you can go and capture a bunch of costs in your inducement resolution, which means you can capture that in your bond financing. A lot of times we've seen deals go all the way through and you get at closing and we'll see that they didn't induce for enough. And you get at to the closing table and the developer will have to come to the table with some money because they are not able to capture some of those costs that they didn't induce for enough. So as a typical rule of thumb, if you think you're going to borrow bonds, $10 million in bonds, it's usually good to induce for 10 to 15% more than what you think you're ever going to actually need to borrow. And so once you've approached your issuer and have told them what you want to do, they will then work with bond counsel and they'll get the inducement resolutions put together. They will bring it to their board meeting and approve an inducement resolution. When you have your inducement resolution ready to go, depending on who's building the project, you will work with that issuer to apply to SIDLAC and TCAC. So that application process, depending on who you're working with, some cities and counties need that application completely done 4 or 5 weeks before the SIDLAC round. Some of them will let you turn in stuff almost up to the day of when they're due. So you need to really work with your issuers and figure out what their timing is and what their cutoffs. We've seen a lot where people were working with some local authorities or some small towns or, groups that aren't really familiar with the process where they thought that they were ready to go, but they realized they missed the cutoff and they've had to kind of scramble, find another issuer that would allow them to go into that round. It's really important this year. There's only 2 rounds for SIDLAC this year. So we've already had our first application round, and that covers 1/3 of the total allocation will happen in June. And then the next round will happen in a few months, and then 2/3 of the rest of the allocation will happen at that last meeting in the year. There's a few other meetings this year that those are going to focus more on exempt facilities and some policies and regulation changes that need to be approved at a SIDLAC meeting. But unlike other years and historic years, we've had some years where we've had 6 allocation committee meetings. But this year we're only having 2. And so timing is going to be the biggest threat, I think, to deals this year. In that you have to have your deal all queued up in time to apply with your issuer to apply to SIDLAC and TCAC. Because 2/3 of the applications are going to be turned in at the end of the year. You don't want to be waiting in line for them to review your application and be able to not get to it because you turned in everything too late. So I would say at least 2 months before the application date, you better start working on your SIDLAC applications. If they have a 2 or 3 week review process, they may not get to your project because you're essentially having almost 3/4 of the year all happening on one Wednesday, what day is it? Wednesday afternoon for the applications. So timing's a big deal. The other reason that's a big deal is we'll get down when we talk about closing, but it's gonna throw off a lot of projects. And I think we're just about to get to that period in the next week or 2 where it's gonna throw off closings. But once you get your SIDLAC application done, you can start working on your Tephra hearing. There used to be a time period where Tephras were due 30 days after applications were due, but that's been removed 2 years ago, I think. And now Tephras are due the same way the Tephras are due for all private activity bonds. You just have to have a valid Tephra at closing. And a valid Tephra has a not to exceed dollar amount in it in the resolution. It has the property address and a brief project description. And those are the important things to remember about Tephra. In addition to that, Tephras are good for 1 year. So you don't want to start working on your Tephra too early, because if you get it approved and you don't get your bond allocation, you've caused a lot of work that invalidates after 1 year. So work with your issuer and they will help you with the Tephra. And, depending on who the issuer is, it could be the Tephra may be able to help locally. If it's Cal HFA, they can hold it up at the state hearing for you. But during the financing process, you'll get your Tephra done. The other thing about Tephras are these were part of the 1986 tax code. These have to be a public hearing. And so 99% of the time, you don't have issues with Tephras, but occasionally you do. Sometimes there's NIMBY issues. We have a deal going right now where the local attorney thinks that this has to be put on a ballot measure, which they're incorrect about, but there's some ballot measure questions. So you got to start working on your Tephra and make sure that everything's good and you don't have NIMBY issues within where the Tephra is going to be held at. But really the key things, Tephras is good for 1 year. You have a not to exceed dollar amount. If you need $100,000 more than what you Tephra for, it doesn't matter. You got to re-Tephra. And then you need to have your property description and your project description within the resolution and within the notice. There used to be a 14-day notice period, but now it's down to a 7-day notice period. So bond closing now needs to happen 6 months after you receive your select allocation. There's really a 6 months, and then there's a 6 months and 14-day period where the projects can fall into. So some of the projects will have exactly 180 days. I think the other one is 192 days. I don't remember exactly, but they do try to spread them out a little bit so you don't have 100 projects closing at the same time. And this is why I think we're going to get into a little bit of trouble by having just 2 meetings this year. Is I know CMFA, we have about 30 projects closing within a week period or 2-week period. And there's really only 2 or 3 bond councils in the state that does 90% of the work. And so you have Jones Hall, Ron Lee is obviously presenting. Then you have Oric, and then you have Paul Timig of Quentin Timig. And that's really 95% of all the bond councils in the state. These guys can't close 30 or 40 deals in a week. It takes a lot of time per closing. And so if you can close sooner than later, it's much advisable. I don't think you want to wait and push it to the last little bit of timing. And the other reason you don't want to push it that late is because there's no longer extensions. So it used to be that if you need an extension, you need an extra 2 weeks, no big deal. We were uncompetitive. It was fairly easy to get an extension. Right now, there's really no opportunities for extensions besides a 5-day hardship extension. So if you get down to the wire and you're on your last day of closing and maybe your signature didn't come in or something happens, you can request a SIDLAC to get a 5-day hardship extension. Besides that, I have not, over the past few years when we've been competitive, I haven't seen really almost any extensions granted, other than we had a few for COVID at the beginning, but we've gone into a period of extensions no longer being granted. One of the only other ones I remember is there was wasn't Saguaro, okay, Joshua trees were on a property and something just came out on Joshua trees, which slowed down the financing, and that was really outside the developer's control because some laws came out about Joshua trees, so they allowed them to clear those or get that cleared up. But extensions are not something that people should be looking at to go past that 180-day closing. Let's go into, we're going to kind of jump back into that first part of the reimbursement or inducement resolution with good versus bad costs. Ron, do you want to kind of give a brief overview here?
Sure. Why don't I jump in for a couple slides here? I actually think for those of you who have a pen and paper, I might retitle this slide and I might call this reimbursement or inducement rules, because that's really what this slide is about, not so much about the good cost, bad cost. Good cost, bad cost, to be a good cost, you have to comply with the reimbursement rules, but this particular slide is dealing mostly with those particulars of the reimbursement rules. And what that means is when you have incurred pre-development costs, can you reimburse yourself, or can the sponsor reimburse itself from the proceeds of tax exempt bonds? And that's what the reimbursement rules governs. The first rule there is you can only go back 60 days prior to your adoption date of your inducement resolution. So that's why Ben was saying it's best to approach your issuer and get your inducement resolution done as soon as possible, so that your line in the sand, as he described it, is as early as possible. You can go backward in time to carry your pre-development costs with your bonds. Now, having said that, the next arrow down says there are exceptions for certain pre-development expenditures, e.g. architectural. This is true. Most design, planning, and permitting costs are considered pre-development expenditures that are exempt from that 60-day rule above. So you don't need to worry about it. One of the rules that's not, one of the expenditures, pre-development expenditures that's not exempt from that 60-day rule is the acquisition of land. So site acquisition could be subject to your reimbursement rules, and that's one very good reason why you should approach someone like Ben Barker when you know you have a project that you're going to be seeking 4% tax credits for. You'll have to ask Ben to get an inducement resolution on file as soon as possible.
Hey, Ron, let me jump in real quick.
Right.
So why this is important is we've had a lot of projects that we maybe induced, there's some projects we induced 10 years ago, and for one reason or another, we're not feasible. Obviously, as we got closer to those projects becoming more feasible, the resolution needed to be updated and things have happened. But, there was a period where we didn't have all these state tax credits that were given out over the last 2 years. We've had this influx of state tax credits. We've had disaster credits and all this new forms of financing come into play. And all of a sudden we had projects that became very feasible and are competitive now. And they were ready to go and they're able to capture all these expenses that were being incurred along the way. Whereas projects that were not as forward thinking, were not able to capture a lot of the expenses that they had already spent on a project now that they became feasible, and they kind of come to you at the last minute looking for an inducement, and it causes some problems with the financing. So sorry to jump in,
Okay.
Ron.
The only other thing I want to say about this particular slide, and again, this is maybe something for the group to note if you have a pen and paper, is that if your tax credit partnership is going to be owned at least 50% by the tax credit investor, which is almost always the case, and if your tax credit partnership is not taking ownership of the land until your construction closing, you generally don't need to worry about the reimbursement rules. So there are some fairly draconian rules, but almost all the time, there's a way to get around them as long as your limited partnership is not taking ownership of the land until closing. If your limited partnership is taking ownership of the land before closing, then please do pick up the phone and call your bond counsel, let them know that, and ask, do I have a reimbursement rule problem?
I didn't want to say there's ways around things, so I'm glad you said it, Ron, since you're the bond counsel that signs off on it. But there are some things you can do if you have some issues, you have a good bond counsel, they can work with you and you can get it figured out. But it's always easiest if you start early instead of trying to fix things at the last minute. And most projects people know about for a long time, and projects don't just happen overnight. People are generally working on, especially since we're doing almost entirely new construction with the current CIDLAC competition. About projects for a long period. And this goes to for a big portion of the group that's on today are local agencies or work for some kind of governmental agency. If a developer comes to you with it, you should work on getting their project induced as soon as possible, not waiting till right up before a CIDLAC application is due. Okay.
Next slide.
Next slide.
Okay, good costs versus bad costs. This is the true good costs slide. The last one, again, I would call the reimbursement slide. The basic rule with respect to good costs versus bad costs is that the proceeds of tax exempt bonds, the proceeds of your mortgage loan funded by tax exempt bonds, 95% of those proceeds need to be used on depreciable, no, I take that back, it's not always depreciable, on capital costs of your residential housing project. So yes, it does include costs that are in depreciable basis, but it also includes some land costs are eligible as good costs. But the basic rule is it's kind of an accounting question. Are they capital costs of the residential project? So if you have a mixed use project with, for example, a commercial component, the commercial component is by definition not a good cost. If you have costs that are not capital costs, things that accountants would consider to be operating expense or overhead, those are also not good costs. But the general rule is if it's a capital cost and it is capitalizable to your residential project, it's a good cost for bond purposes. The third bullet point down I'd like to draw your attention to that one, functionally related and subordinate facilities. You might say, well, Ron, we've got a parking lot, we have a community room, we have laundry facilities. We've got some things that are not, we have common areas. We have some things that are not residential per se. And the rule there is, as long as those are functionally related and subordinate to your residential use, and as long as they are, I'll call it right-sized for your residential use, they're also considered residential use, and they are a good cost. So what I mean by right-sized is you can't finance with tax-exempt bonds functionally related and subordinate facilities like, say, a parking lot, if it's not right-sized for your residential use. And an example of that might be, let's say you are developing a downtown affordable housing project, and along with that downtown project is a parking structure. And let's say you have 100 units in your building, but you build a 500 stall parking structure because you want to rent out 400 of the spaces to office tenants nearby. Well, that 400 of the 500 spaces would not be considered right-sized, and your bond counsel might tell you, well, 400 out of 500, 80% of the cost of your parking structure is not really functionally related and subordinate, and therefore is not a good cost, and you're going to have to find some other way to finance it besides tax-exempt bonds. So that's what's meant by right-sized. Managers units, also we consider those functionally related and subordinate facilities, even though they are a residential, apartment unit. They're not restricted units. They're not rented to tenants at large. We treat managers units the same way we treat, for example, a rec room or laundry facilities or parking. It's functionally related and subordinate. That means it has to be right-sized. So if you had a 40-unit building and you told us, well, we're going to have 4 live-in managers, each with their own unit, we're probably going to tell you, well, that seems like that's off market, and normally you'd only have 1 live-in manager, and only 1 of those can be considered a good cost. The other 3 units are not functionally related and subordinate. Okay, next. Oh, I'm sorry, I've got a whole right-hand column of this slide to talk about. Land costs are financeable with tax-exempt bonds only up to 25% of the bond size. That's typically not a problem. Oftentimes, the land is coming to the developer at no cost with respect to deeply affordable projects, but also because these projects tend to have so many sources of funds that the land cost can be allocated away from the bonds to something else. Up to 2% of your bonds can be used for costs of issuance, which is essentially transaction costs of the bond. Typically, that's also not a problem because, again, you generally will have many other sources of funds that are not tax-exempt bonds in your capital stack that can't be used to fund costs of issuance. Next slide, please. We have another poll. Are the costs associated with a tax-exempt bond transaction considered good costs or bad costs? I don't think I answered that, but go ahead and take a guess.
All right, we'll give everyone a few minutes longer. Or a few seconds longer, not a few minutes to answer this one.
I actually don't have the results of the poll available to me.
I have it wrong. I'm waiting for, I can see everybody answering right now. We're about halfway through, so either after you fell asleep or this is a hard question.
Oh, here it is. Sorry, it popped up. Okay, that's everyone, I think. Or is it? No. Oh,
it is now.
Okay, well, let me just go ahead. So the answer is Cost of issuance, they can be financed with tax exempt bonds up to 2% of the bond, but the actual answer here is they're not considered a good cost. They're a bad cost. The 2% that the good cost rule is 95% of your bond must be used for good costs, which the flip side of that is 5% of your bond can be used for bad costs. Up to 2% of that 5% can be used on cost of issuance. So it's part of the bad cost bucket.
Thanks for pitching in on that section, Ron. I think we went over a little bit. So Dave, how long do we want to do for the 10-minute break? We doing full 10 minutes?
Yeah, I think we're still pretty good on time. We've got a generous Q&A period at the end of this presentation here. So folks can come back around 2:05, 2:06. We will see you then. Before you go, got a couple of sort of housekeeping things. Number one, I think most folks have found the chat. That's what we're using for the Q&A. Thought we had a separate Q&A module for this presentation. We don't. That's fine. So feel free to post your questions in the chat. And Claire had earlier posted conference materials in the chat. Hopefully everybody has accessed those already. But just in case, you can scroll back up and you can download those materials. We'll see you in 10 minutes.
Dave, should I go ahead and get started with this next slide?
Yeah, I think we're ready to go, Ron. Thanks.
Can you advance to the next slide? There we go. Okay.
And actually, Ron, I'm sorry, I'll jump in here and kind of introduce this slide before you get going. So from time to time through this presentation, we will have references to a case study that you see in front of us. It's the Avenue Apartments. It was a project in Sacramento. And just as like the very basics, you know, it was new construction, 24 units, large family housing type. It's in a high resource area. It serves 50% special needs homeless. And there's a 4% tax credit bond combo on this with a total cost of development of about $18.5 million. So we'll come back to this from time to time. This is just kind of the brief intro to the case study, but just so everybody knows what we're talking about here. That's the Avenue. Thanks, Ron.
Okay, well, I think I would like to just kind of outline who the key participants are in a private activity bond transaction. And this is geared toward one type of private activity bond transaction, which we refer to as a private placement. A private placement is one where the bond purchaser is identified and the business terms are negotiated by the developer directly with that private placement purchaser. Typically, it's a bank or some other type of institutional lender, and private placements comprise probably 90% plus of all affordable housing bond transactions we see these days. The typical key participants are the borrower, who is the limited partnership tax credit ownership entity that the developer has formed. Bond counsel, that's typically a law firm like ours. Issuer, those can be cities or counties or housing authorities, sometimes a state agency, maybe more often a joint powers authority like California Municipal Finance Authority. The issuer typically has their own financial advisor, someone like Ben Barker. The bank / lender, and I'll add / bond purchaser, is again a financial institution that is typically operating in the affordable housing space specifically. I think later on we will talk about some names. And occasionally you will see in a private placement a trustee or a fiscal agent, which is a large, usually corporate trust bank You don't always see them in private placements. In fact, I would say it's the exception rather than the rule, but nonetheless, we've listed them here. Next slide, please. So for the Avenue Apartments, here we're going to just add some names here. Natomas Housing will be our developer slash sponsor, and they will be forming the borrowing entity, the limited partnership. Bond Counsel, I think may be important to note for this group that Bond Counsel represents the issuer. So they represent CMFA. They do work very closely with the borrower. Of course, they are pulling on the rope in the same direction and trying to help the borrower achieve its financing goals, but it is important to know that their client relationship is with the issuer itself. Here in our example, the issuer is the California Municipal Finance Authority. Our issuer financial advisor is a person named Kelly. Our bank lender is what looks to be a made-up portmanteau financial institution called Wells, and our trustee is similarly a financial institution, which I presume is made up by the name of Far Chase. Next slide, please. And you see that the little emoji guys have proliferated, and that is because everyone seems to also bring their own lawyers. So the plus signs in this list here are the various parties who are also bringing their own lawyers into the transaction. The distribution list for the transaction gets longer and longer, and yeah, pretty soon you have a full page of people to invite to your conference calls. Next slide, please. Okay, the next 3 slides actually are going to be pictures and flowcharts, and I actually kind of like talking about these particular slides because I think they help describe in short form what bond counsel's bond documents say. You're going to get a stack of legal documents from your bond counsel saying, here's how our bond deal is structured, and usually to the uninitiated, they are basically gobbledygook. And hopefully over the course of the next 3 slides, I will give you the Cliff Note versions of what those documents say, and will help you understand them when you actually do read them. So this first of the 3 slides that I mentioned, slide 32, is really not a bond transaction. It is depicting pictorially a conventional loan financing transaction. So in this particular transaction, you have 2 little bubbles there, ellipses, each representing one party. The upper bubble is our lender, UniWells, and again, the lender might also be referred to as your bank or maybe referred to as your bond purchaser. They're really all the same thing. And the lower bubble, of course, is the borrower. It's a limited partnership formed by our sponsor, Natomas Housing. And in your typical loan transaction, you have the arrow on the right-hand side where the bank sends the loan proceeds to the borrower, and the arrow on the left-hand side heading upward is the monthly loan repayments made by the borrower back to the lender. That's something I think all of us readily understand. It's something we've seen a gazillion times in our daily lives. Next slide, please. So on this slide, we have the exact same picture on the left-hand side, and then we have something a little bit more complicated on the right. But if you really kind of focus on what's going on the right-hand side, it's not that much different. You'll notice here on the right-hand side, the uppermost bubble is still your lender, and the lowermost bubble is still your borrower. What's the difference? Well, interposed between the two, we have a third party, CMFA, the bond issuer. So the way a tax-exempt bond structure works is very much like a regular loan structure. It's just you have another party in between the lender and the borrower. And you'll notice that the arrow on the right-hand side is now 2 arrows. There's going to be an issuer loan. The lender is going to loan the proceeds of the loan to the issuer. And then that lower downward arrow is a loan from CMFA, the issuer, to the borrower. So it's the same transaction. It's just now this loan is being made through the issuer. It's going from lender to issuer to borrower. And that all happens in the blink of an eye. It all happens simultaneously at closing. The thicker arrows that are pointing upward are the loan repayments. The borrower will repay monthly loan repayments to CMFA, the issuer, and the issuer is supposed to forward those repayments exactly in the same time and amount to Uniwells, the lender. So again, this is really the same transaction. It's just you've interposed a middleman who is taking money and handing it off. Now, those of you who have done bond transactions are saying to yourself, we don't pay CMFA, the issuer. We get the money directly from the lender. So that is what the skinnier arrows on the outside of the diagram represent. There's a skinny arrow on the right that's going from Uniwells, the lender, all the way down to the borrower, and a skinny arrow from the borrower on the left going up to Uniwells, the lender. And the reason I've drawn those two particular arrows there is because since CMFA is just a middleman and is just passing the same amount of money from one party to another, the parties will all agree at the closing that we don't really need to do that particular step. Since the money is all going to end up in a particular place, why not have the money sent directly there? So the parties all agree that yes, there is a loan from Uniwells to CMFA and a loan from CMFA to the borrower, but rather than making it two arrows, let's just bypass the middleman and have the money go directly from the lender straight down to the borrower. That's the skinny arrow on the far right. And similarly, the repayments, they don't need to go through CMFA's hands since they're supposed to be forwarded immediately to the lender anyway. Let's just have the borrower pay the lender directly, and that is what the skinny arrow on the left is. And all three parties it's perfectly legal for them to agree to do that, and that's what they do, all as part of the bond documents, and that's what that's supposed to represent. Next slide, please. Okay, so here is a slight variation on the theme here. This is the same diagram as we saw in the previous slide on the right-hand side, but we've introduced a fourth party here on the right-hand side. We have Far Chase, our bond trustee. You typically in private placements will not have a bond trustee, but there are some situations where it's required. Those situations include deals where your conduit issuer requires a trustee. CMFA does not require one, but there are some cities, for example, that require a trustee. I believe College FA, I believe, requires a trustee. There are also some lenders that require a trustee. If you have a Freddie Mac perm loan, they require a trustee in the transaction. The trustee, I think, is best thought of as kind of a loan servicer, a money handler. And when you do have a trustee in your transaction, the loan proceeds on the right-hand side, you see the skinny arrows on the right-hand side. Those loan proceeds may flow through the trustee from the lender to the trustee and then down from the trustee to the borrower. Again, the two skinny arrows on the right. It's also possible that the loan repayments can flow through the trustee. So I know we don't show that here. The skinny arrow on the left is going from the borrower directly up to the lender. That is possible, but it's also possible that the parties will want the loan repayments to be made by the borrower directly to the trustee and from the trustee to the lender. And the only way that affects the developer in any way is it's just who you're writing your check to on a monthly basis. It shouldn't really be any more burdensome to the developer, but there are different ways you can slice and dice this. And with a trustee, you just have the money flowing in a slightly different way. Next slide, please. Okay, the flow charts in the last three slides, those were depicting a private placement, we really have two structuring options. We have the private placement and we have a public offering. Those are really the two flavors of bond deals. Private placements tend to comprise, I would say, at least 90% of new multifamily housing bonds issued in California annually. We don't do public offerings very much. They have fallen out of favor. Years and years ago, they were probably more common, but certainly the trend in at least probably the last 10 years plus has been toward private placements. And again, you will have a bank or other institutional lender. They're sometimes referred to as your lender and sometimes referred to as your bond purchaser, because the way they're making the loan is by purchasing a bond or a note or some other instrument. Purchasing a bond is, by the way, economically identical to making a loan. So when they say a bank is purchasing the bond, it's really the same thing as the bank is making a loan. Pooled financings, state housing finance authorities like CalHFA, they often will issue large amounts of bonds, let's say 100 million plus, use the proceeds then to make loans to multiple projects. Other issuers in the state don't do it that way. They issue one bond issue per project. Public offerings, again, they are far less common these days. The ones I think I probably see the most of are the cash collateral deals that maybe some of you have seen. I don't think I'm going to spend a whole lot of time on them because they are the exception rather than the rule. One difference between public offerings and private placements is public offerings are, the bonds are not sold to a single bank or other institutional lender. They're sold to the bond market at large. And though bond investors in the bond market at large are not going to take the time, they're not set up to essentially get to know your project as well as a bank will and do all the due diligence that a bank does. And so they require something called credit enhancement. It's essentially, you know, key that the developer has to pay for in order to sell the bonds. The bond market at large usually wants to deal with investment grade rated debt, and therefore that's why they require credit enhancement. Next slide, please. Okay. Bond financings, we touched on this earlier. Bond financings have higher transaction costs. You have to hire a bond counsel, you have to hire a conduit issuer. There are a number of other deal participants that are involved in bond transactions, but they often have lower interest rates than taxable debt. If the recipient of the interest does not have to pay income taxes, theoretically, they should be willing to take a lower interest rate on that debt. It's tax-free to them. Sub-bullet, this is very important. I actually believe that the lower interest rates are not what drives bond transactions in multifamily financing. What really drives bond transactions in multifamily financing is the fact that federal law requires tax-exempt bonds as part of your capital stack in order to get the 4% tax credits. So in some ways, the bond deal is the tail, not the dog. The tax credits are the dog wagging the tail. So it's, I think, probably best to think of it that way. Costs do vary depending on the structure. In a public offering, you have even more deal participants that need to be paid. There's an investment bank that we'll refer to as an underwriter. They're the ones that will go out and sell the bonds to the bond market at large. They require counsel as well. There may be some additional add-on costs to doing a public offering. So there usually has to be some good reason to do a public offering versus a private placement. Next slide, please. Okay, private placement examples. In a private placement, the bonds are typically sold to a bank, usually just one bank. Sometimes there may be a co-lending situation where there could be a couple of banks, but the typical transaction is all your bonds are sold to one institutional lender. It's usually a bank. There is something called the CRA, the Community Reinvestment Act, that does regulate banks, and it basically says, for our purposes, it says that banks, if you want to do business in your, your local footprint, you have to make loans that benefit the communities in that local footprint. And one of the ways they discharge this legal duty, it's a federal law. One of the ways they discharge this duty is by doing financing, making mortgage loans to affordable housing projects in their local footprints, the ones that they want to operate, commercial and retail banking operations. So they have not only a profit incentive in making loans to affordable housing, they have a federal regulatory reason they want to do financing for affordable housing. It's known as CRA, and they get credit against their CRA obligations. You can do a direct replacement to an institutional buyer, and that is, again, I think a rare case. I happen to be working on one right now, but it is kind of a unicorn deal, and you don't often see them. Next slide. Okay, so these are examples of types of public offerings. Remember, we talked about the idea that the bond market at large, which is where the bonds are going to be sold in a public offering, those bond investors are not doing the same kind of due diligence that your typical private placement lenders are doing. They don't get to know the project as well, and what they really just want is they want a guarantee from somebody who's highly rated. So that guarantee can come in the form of a bank letter of credit, which is essentially a bank promising to repay those bonds, and then the bank enters into a reimbursement agreement with the project, and they take a deed of trust on the project, and they take the credit risk. So the bondholders are kind of guaranteed to be paid off as long as the bank has the wherewithal to pay the bonds, and it's up to the bank to collect the money from the project. They take the credit risk. Another example is government-sponsored GSC, government-sponsored enterprise. I forget what that stands for. Anyway, Fannie Mae or Freddie Mac, which are federally chartered lending institutions, private shareholder-owned, but federally chartered. We refer to them as GSEs, and they have large balance sheets and good credit ratings, and they can also provide these types of guarantees that the bond market at large is looking for. We don't see that very often anymore. And then, of course, the last bullet point, there are certain types of HUD FHA loans which can be used in conjunction with a public offering. I don't think I'm going to spend a lot of time on that, but essentially, if you can get a HUD or FHA loan, and maybe Dave or somebody else, you can correct me where I'm going astray here because I don't know that much about this, but if you can get a HUD or FHA loan, but you really want 4% tax credits, you can structure a deal where that's kind of turned into a publicly offered tax-exempt bond deal that would satisfy your 50% test and would allow you also to get tax credit equity.
That's right, Ron. Usually what you would see in the HUD FHA space, I think, is more of a cash collateralized structure where you've got a separate loan coming in from FHA, and those funds are available sort of as a backstop for the bonds. So the bonds effectively already have the cash on hand to pay them, just kind of sitting there. But just as a general thing, as your friendly financial consultant, I would advise you to think very carefully before getting into a public offering. Say about 99 times out of 100, they are absolutely not worth the headache. So just, selfishly and for my own sanity, I would just advise you to, ponder this really hard and not really use these structures unless you absolutely have to.
Okay, next slide, please. Okay, construction bonds. Let's talk about a little about construction bonds. The typical way to structure a construction bond is to structure it in a drawdown structure. So what that means is you're not getting all of the money up front on day one. You are applying for draws from the bond purchaser on a monthly basis, as and when your development needs require. When your contractor tells you you owe me, you know, $1 million this month, then you can go and draw down $1 million from your bond purchaser and use that to pay your contractor. And you can do that for, you know, 18 or 20 months or however long your construction period lasts. At closing, when you close the deal, there has to be a minimum draw. Here, I guess we're saying in this slide, it's $50,001. I will say that there is a split among the bond counsel community. It's not a big deal, but some bond counsels, including our firm, require a minimum of $55,000. So we're talking very small differential here, but don't be confused by the different requirements in different deals. Some bond counsels might tell you 50,001. Some might tell you 55,000. We're all referring to the same requirement. I think there's probably a typo in that bullet point. The 90 to 110 day issuance deadline was the old rule. CIDLAC used to only allow approximately 3 months, 90 to 110 days to close your deal once they've given you the bond cap. Now the time frame they give you is 180 to 194 days, and you don't know which you're going to get until you get their resolution, but it's either going to be 180 or 194, which is approximately 6 months. So rather than approximately 3 months, it's now approximately 6 months. As Ben Barker mentioned earlier, for the last 2 years, CIDLAC has not granted extensions, and this was one of the ways I think they were mitigating that, is by changing the rule from 3 months to 6 months. Some examples of tax-exempt construction lenders include Citibank, U.S. Bank, Wells Fargo Bank, Union Bank. There are many others, including regional banks, Umpqua Bank, Pacific Western Bank are some of the ones that I've seen. There are some other national banks that aren't listed here, J.P. Morgan Chase Bank. Your friendly financial consultant is on a first name basis with all of them. I'm sure I've only listed them, but your financial consultants know them all. And I guess the main point of this slide is the very last bullet point: avoids negative arbitrage. Well, what is negative arbitrage? What is arbitrage? Arbitrage is basically exploiting the inefficiencies in economic markets. It's a very broad definition. In this case, negative arbitrage refers to the idea that if you have let's say a $10 million construction loan and you borrow it all on day one, the bank obviously is expecting you to pay interest on $10 million on day one. Even though you don't need all that 10 million on day one, you only need bits and pieces of it on a monthly basis in order to pay your progress payments. So if you were able to draw down the $10 million on a monthly basis and only start paying interest on the amounts you've drawn down, you could save yourself a lot of interest cost. And that's what is referred to here by the term negative arbitrage. It's the idea that you are borrowing and you are borrowing and paying interest on money that you don't need yet. It's just sitting there. It's a dead cost that you would, under other circumstances, prefer to avoid. And so that's done through a drawdown bond, and you only draw down the money that you need and you immediately spend it. So there is none of this dead cost, if you will. That's all I have to say about this slide. The 50% test, and I'm going to turn this back over to Dave because he's an expert in this and I'm not.
Great. Thank you so much, Ron. Yeah, so the 50% test is, you know, as a developer or as a sponsor, it's absolutely one of the most important things you need to keep your eye on for these tax-exempt bond 4% tax credit transactions. You know, the gist of the 50% test is that you need to demonstrate that your bond proceeds cover at least 50% of what we're terming as the aggregate basis of the project costs, right? And so there are a few different things that these terms mean in a few different ways. And I think I'll reiterate here that, the tax exempt bonds and the tax exempt, the 4% low income housing tax credit stream that you can bring in by doing one of these transactions they're separate, and they're administered through separate parts of the tax code. And in fact, they're administered by separate state agencies. Both of them are under the umbrella of the treasurer's office. But CIDLAC handles the bonds and TCAC handles the tax credits, and they are separate. You get your 4% credits kind of by right when you do a tax exempt bond transaction of a certain type. But we have to kind of pay attention to the rules separately. And this is actually a tax credit rule and not a tax exempt bond rule. But basically, I think the gist of this is, and why they put this in place way back when they started this program, was to make sure that people weren't kind of gaming the system by bringing in a very small tax exempt bond amount and then taking an enormous tax benefit out of 4% tax credits, right? They wanted this kind of to legitimately be tied together between these two things. So if you have a 50% test score of 50% or above, you're fine. You will get 100% of the tax credits you're entitled to, and everybody's happy. But if you manage to not hit 50% here, the results are pretty drastic. So you will only get the percentage of the tax credits based on your 50% test score, right? So if you come in at 47% on your 50% test, you only get 40% of your, or 47% of your tax credits. And, as you might imagine, that would be absolutely disastrous. Basically everybody's going to walk away from the deal, and it will be a great big mess at that point. And so the two terms here, bond proceeds and aggregate basis, mean something, we want to be a little specific about what these are. So, the bond proceeds refers specifically to the tax exempt bond proceeds. Those are the only one, that's the only portion of the proceeds that count. If you have a project where you've got a tax exempt loan and then a taxable tail, even though the taxable tail might technically be a bond, it will not be a tax exempt bond for this purpose. So you have to pay attention to that. And then the aggregate basis is just broadly speaking your depreciable basis plus land. And depreciable basis, when we talk about that, it's more or less your eligible basis for the tax credit transaction, though there are some very small discrepancies sometimes. Probably not enough to worry about in this particular class, but you may run across a situation where your depreciable basis doesn't meet your eligible basis. So you have to make sure you check in with your auditor or your financial consultant to make sure you're catching all your costs there. And then when we refer to land, we don't just refer to the cost of the land, but we refer to land related costs, right? So this can be a broad number of things. It could be, for instance, legal fees related to the land transaction, or title costs related to the land transaction. It could be interest on a land acquisition loan, if your partnership acquired the land prior to the closing of the bonds. It could be relocation if you have to relocate folks because you're demolishing an existing structure on the property. Those relocation costs can often be tied to the land, especially if you're clearing the land through demolition. And the demolition costs themselves would also be included there. So it's not just land, it's land and land related costs. And we'll kind of go through the gory details of that when we go through the exercise here in a few minutes. So when is this test done? So basically, like we said, it's a tax credit requirement. So if you're doing some other form of tax exempt bond transaction where you are not getting the 4% tax credits, it's not relevant. But if you want those 4% tax credits, you need to satisfy the test. Timing wise, it can be done as early as you place the building in service, which is typically when you get your C of O, or at the latest, it would be the last day of the year that you place it in service. So in terms of that, the auditor will do your test. Basically, you'll go through your cost cert process. The auditor will go through and certify that for you as part of your cost cert. If you read your LPAs and your loan documents, you'll typically be obligated to provide proof from your auditor that you've satisfied this before your financing partners will let you convert to permanent financing. And then to account for the test, these bond proceeds must be spent on land or basis items. So basically, you need to demonstrate that the bonds that you're claiming in the numerator are satisfying costs that wind up in the denominator of the test. But again, Ron kind of went over some specifics about reallocation of costs, and this is kind of a really good thing for us as we try to satisfy this test. You don't need to make a direct line between when you spent the money and what you spent the money on, right? So, you don't need to hand your auditor a draw, say this is our January draw, we spent $500,000 of the tax-exempt bonds, and these are the exact costs we paid for them. You can go back after the fact and reallocate them to make sure that all of your bonds can be counted in the numerator, and you'll absolutely want to do that for the purposes of satisfying this test. We had a question come through the chat. Are environmental remediation costs eligible? And for the most part, as Tyann has answered, the answer to that is yes. That they are considered a land improvement, and so they would be kind of tossed into that land cost bucket with other things like land acquisition. So moving on here, the 50% test must be met by the building. And again, this goes back to the fact that this is a low-income housing tax credit issue. As you place buildings in service and claims tax credits on a building by building basis for the most part, not on a project by project basis. So if you've got, say a suburban development with 15 or 20 buildings and it's stretched over multiple years when you're placing these buildings in service, you've got to be pretty careful because you need to satisfy this test based on each building that comes up. And, sometimes if you've got a building that comes online really early in the project, it can be pretty difficult to demonstrate that you've satisfied the 50% test. Because you've not drawn down all your bonds yet, right? And we can usually get around it, but it's something that kind of merits special attention as we're taking a look at this. So when we're underwriting this, we build in a cushion, and yet again, we have failed to update the slides on this. Nobody's really doing 55% anymore. Because the amount of bonds you're requesting is kind of a competitive factor in getting a CIDLAC allocation. So typically these days we'd see that number down around 52, 53%, sometimes even lower, which just makes everything that much more difficult to kind of thread the needle and pass this test. But because the competition is competitive and because we're trying to stretch limited resources, folks have backed down their cushions quite a bit on the 50% test. When you go in and you apply for bonds, this is really important to kind of work with your tax counsel or your CPA, even your investor or your financial consultant to make sure that everybody's in agreement as to what will be basis eligible. Most of these items are kind of not in question, but there are a few items that can go either way depending on what elections you take. Under the tax code or some other issues. It's really important to make sure everybody takes a look at this so that you don't get hit with a sort of surprise amount of costs that come into basis that you weren't anticipating and you weren't accounting for when you signed your tax exempt bond request. Finally, you really want to monitor this during construction. Monthly perhaps is a bit aggressive, especially at the beginning of the project, but of special note, when you start to have cost increases and specifically cost increases in construction that aren't contemplated in your contingency, or that if you've got really major cost overruns, that's going to be a problem because all those costs go into the denominator, but once you've closed, it's really difficult to push the numerator up as well. It's really difficult to go in and get more bonds without going through a separate competitive process, and there's like kind of a whole nother thing there. So once you start hitting these cost increases, it's a really good idea to check back in with your auditor or your financial consultant to make sure that you've got everything covered. And so just as kind of an example here, and we'll go through a full exercise but in a minute, but we'll go through this sort of Avenue Apartments case study one more time. Here's our development budget, and you can see kind of where we have put things from the development budget into the 50% test, right? So the land value itself, of course, that's a land cost, so that would be in the 50% test denominator. Your construction hard costs, they're all going to be depreciable with a few exceptions, but for the most part, you're going to see them all be depreciable, so they would go in the denominator. Your permits and fees and your architecture and other soft costs, the vast majority of those are going to be depreciable basis items, so they would go in the 50% test as well. Your permanent loan fees would not, because your permanent loan fees are typically going to be amortized. They're not going to be depreciable basis. They're not going to be eligible basis for your tax credit purposes, so those would be held out. For the construction loan, you've got this distinction between what happens before place in service and what happens after your place in service date. And typically we would see construction loan costs, especially on a new construction project, be included in basis for the period before you can complete construction. But after you complete construction, you get your C of O, you start moving people in, your basis clock is going to stop, and everything from that point on will not be includable in basis. And so, contingency costs, to the extent they're spent on depreciable items, those are going to be basis eligible. Your developer fee, it's everybody's favorite, and it's absolutely eligible. But your reserves and your syndication costs, so, legal costs related to the syndication, your audit, your financial consultant fees, those types of things would not be included in basis. So you see in this example, we've got a development budget of about $18.5 million, and roughly something like 360,000 of those dollars are not eligible in the 50% test denominator. So you're usually going to come up with a situation where you're close to having your 50% test denominator be equal to your total cost of development, but you're typically going to have a pretty substantial amount that's not included. So you have to kind of pay closer attention to what you do and don't include there when you size your bond request. And so we'll kind of work our way through this. We've pulled the land and basis figure from the prior page. We'll skip down to what our sources are here in the second, third sections of these tables. And so this is a pretty standard deal, don't have a ton of sources here, but for construction, we've got a $10 million construction bond plus a $4.6 million taxable tail. And we've got a little bit of local money, a little bit of LP equity for the permanent phase. We've got a smaller perm loan of about $4.1 million, some HCD funding, and then again, local money and equity rounding out our stack. And so a couple things are important here. And, first off, as we discussed before, the only part of the bonds that get included in the 50% test in the numerator is going to be the tax exempt portion. So in this case, you've got a total construction loan or total construction bonds of, about $14.6 million, but you only get to count the 10 million in the numerator of this test. The second issue is, sometimes you will have tax exempt loans that are either paid down partially at conversion, or maybe a new tax exempt loan will be made at conversion. And in that case, you always get to use your construction loan amount to determine what you put in this test, which is great. Your construction loans are almost always bigger than your perm loans. In fact, I can't think of a situation in which they wouldn't be. So you're always going to want to use that higher number, and you can rely on the construction loan amount for that. And so going back up to the top here, basically, conveniently enough, if you divide 10 million by 18,181,818, you will get roughly 55%, maybe just a hair higher, but it's almost 55% on the dot. So when we've done these projections, we've taken into account our total land and basis number of this $18.1 million, and we've backed into the $10 million bond request based on sort of our target amount of 55%. So that was quite a bit of information there. Encourage folks to ask questions if they've still got them, but we'll move on to our next poll here, which is which element does not impact the 50% test? feel free to take a look and let us know what you think. All right, we'll close out in just a few seconds here. Okay, we'll wrap this one up. And the answer here, most folks got, is rental income. So both land and depreciable basis wind up in the denominator of the test. And that would be why they're included, but rental income doesn't come into the picture. So good job, folks. So moving on here, we will go to the 50% test exercise. And Claire, I think I'm going to hand it off to you.
Great. Thank you so much, Dave. So I know that was a lot of material that we just covered, everything from bond basics to good cost, bad cost, the 50% test, the different structuring options. There's a lot to absorb when it comes to tax exempt bonds and how they're structured and why they're so important. But as Dave mentioned, one of the most important elements that you take away from today is understanding the 50% test. And what better way to understand it than to try an exercise. So we're going to go ahead and do an exercise. It's going to take us about 10 to 15 minutes. If you look at the chat, you should have seen me somewhat excessively posting a link to a Google Drive folder where you can download 3 different files. So the first file is going to be the slide deck. So you'll want to keep that, take notes for the rest of the session on that if you haven't already. And then there are 2 other documents. One is a PDF that I'm about to share on my screen of the 50% test exercise, and another is something that looks very similar, and it's in Excel. So if I think I can share my screen at this, this will stop other students sharing. Okay, cool, thanks. Okay, so here we go. Hopefully everyone can see my screen right now. Actually, can one of my fellow presenters tell me if you can see 2 different, an Excel and a PDF? Can folks see that?
Yes, we got them both.
Thank you. Thanks, both of you. Okay, so when you download those 2 files for the exercise, this is what you'll see. The first one is a PDF that is, if you were in person, we'd be asking you to hand calculate, but one of the benefits of Zoom is you can use Excel. This is where you're going to actually do the exercise itself. What you're going to do essentially is calculate what the 50% test kind of quote unquote score is for this hypothetical development. And so you're going to fill this in. We have this version in Excel, if that's what you prefer to use, where you can actually type in the different numbers from the exercise and do formulas and calculations. If you prefer, you can also print out the PDF version and do it by hand. Extra bonus points if you do that. So the information that you need are on pages 2 and 3 of the PDF version of the exercise. The first page is the sources of funds. So this is the different sources for both the permanent phase and the construction phase. From this page, you'll just need 1 number. I'm not going to tell you what it is, but look for the tax exempt bond, right? And then the second page is the uses, right? So this is where we have all the development costs associated with the affordable housing development. Now, remember that the 50% test denominator is going to be your depreciable basis plus land, right? So keep that in mind. It's the depreciable basis plus land costs, right? And it's not just the straight land cost here. Actually, I'll zoom in. It's probably pretty small for you to see. It's not going to be just the straight land cost. There are other costs associated with the acquisition that also get calculated in the 50% test. So over on your exercise, you're going to put the bond amount request here, right? So find that on the first page. You're going to put in the depreciable basis plus the acquisition costs and all the associated acquisition costs, right? It's not going to be just the land itself. That will get your total aggregate basis. And you're going to calculate what percentage of your aggregate basis the bond request is, right? And remember, we want this one to be over 50%. So check yourself. If you're getting something like 10% or 20% or 80%, it's probably not right. It's probably gonna be close to around, near to around 50, give or take 10% in that cell. And then if you want to, you can take it a step further and see, okay, well, what would my maximum basis, aggregate basis be that I could have with keeping my bond request stable. Now, constant. Remember that you apply for the bonds and then you don't get more bonds if your depreciable basis and land go up. I mean, you can technically apply for a supplemental, but it's not super common. And so you want to know what's sort of your buffer. If your depreciable basis and land costs go up, how much buffer do you have while still keeping your bond request the same in order to pass the 50% test? And that's what this sort of last question is. I think we'll give you all about 10 minutes to work on this exercise until 3:10 p.m. And then we'll come back and do answers. And if there is a brave soul out there for extra brownie points that wants to share their answer, we can go ahead and do that. For now, does anyone have any questions on the exercise? Where to find the materials? Oh, it looks like Netta. Okay, Dave, you're gonna send them the materials via email. Any other questions? Okay, I'm gonna turn my video off. I'm gonna stop sharing my screen. But should you have any questions, feel free to either pop them in the chat or pipe up and we can answer them. And we'll regroup at around 3:10 and share answers. Thanks. All right, I think we'll go ahead and get started with the answers. Does anyone want to volunteer what they found? And it's okay if our answers are a tiny bit different here and there, but we should coalesce around something pretty similar. And if there are no volunteers, I'll go through the answers, but I would love a volunteer. Anyone? All right, that's fine. I'll go through what the answers are. Okay. So here we are. I have two documents open. One is the PDF of the exercise that you had, that you downloaded here on the bottom. And then part by part on the top of the screen, I'm gonna reveal the answers over in this Excel document. So the first cell, we wanted you to fill in the bond amount request. And remember here, it's kind of a strange concept, but the bonds are your construction loan. Not always your full construction loan, right? We've talked a little bit earlier in the session about how you can have two types of bonds. You can have a taxable tail and a tax exempt construction loan, but we're talking here about the tax exempt construction loan. So in that case, the bond request here is the bank tax exempt construction loan right here for 25 million. So you all should have put $25 million here in the bond amount request, okay? All right, the next one, total depreciable basis. For that answer, we're gonna scroll down to the second page. Remember, I gave you a little bit of a hint here, depreciable basis, right? So the total amount between these two columns. And you scroll to the bottom, we've got $42,911,141. We plug that puppy in here in total depreciable basis. And remember, it's not bond request over total depreciable basis, it's bond request over depreciable basis plus land. And that's where the exercise gets a little bit more in the weeds. So again, we're using the second page of the exercise and we're gonna put the acquisition cost, the land here at $2.7 million. And then we're going to add all of the costs associated with the land acquisition. We're going to, again, collect all of these costs from our uses page, right? All the development costs associated with the land. So we've got And it doesn't have to be in this order. And you may have gotten something, you know, very slightly different, but this is where we're hoping you'd land. So the land closing and holding costs here for 45 grand. That's this number here. And I'll zoom in because it's probably pretty tiny. Here for 45,000. The next one is the demolition, 210,000. That's what we've got here. The appraisal. Now we're assuming here that the appraisal is for the land. And you can even see here, oops, that we've labeled it. Sorry, I'm having trouble highlighting things. We've labeled it as land, right? That might have been a little bit of curveball. Some of you may not have picked up on that, but that appraisal is associated with the land. So it gets calculated in the denominator. In this case, we've got relocation included. That is, where's the relocation? Here we go. For existing units that are going to be demolished, goes there. The city loan fees and expenses, 35 grand. That's going to go here. And then the legal fees associated with the acquisition also is going to go in this calculation. Now, in this example, we're assuming that we're going to be demolishing a number of units completely, and then those costs get lumped in to this calculation because we're demolishing them completely. So therefore, the total aggregate basis amount, now I'm going to expand this, you can see is a sum of depreciable basis and land and all the associated costs, right? So it's a sum of all of those. That's going to be our denominator. And then we can get the 50% test score by dividing the total bond request over the aggregate basis. We get just shy of 55%. And then the last, so in this case, we pass, right? That's fine, we're passing. It has to be above 50%. And then the last question was asking you to calculate, okay, what's our buffer, right? So how much aggregate basis could we have in this development? Since we're already in this scenario, we're going to pretend that our bond request has been awarded, right? So what's the buffer? So we currently have almost $46 million in aggregate basis. We could have up to almost 50 million in aggregate basis. And the way that works is we just take the bond request amount, multiply it times 2, right? That would get us exactly 50%. And actually what we probably want to do is subtract out $1. Because you have to be over 50%, right? And so our buffer is going to be the amount between what the maximum could be and what we currently have as our aggregate basis. Okay, so that's the calculation. I'm going to post a PDF version of the answers onto the Google Drive so that you can download that and take a look offline. Again, the 50% test is something we really want you to know well coming out of this class, because it is so central, as others have said, to the ability to collect tax credits. If you don't meet the 50% test, you might as well say adios to all of your tax credits. And so it's absolutely critical that a project meet the 50% test. It is definitely make or break. I think with that, we are now going to take a break, let's say until 3:25 p.m. And we'll come back and we'll jump in. We'll kind of take a little bit of a shift away from the sort of structuring and bond basics into SIDLAC, scoring, tiebreaker, changes at SIDLAC, all that fun stuff. So 3:25 p.m. Thanks. Hi, everyone. I'll hand it back to Dave in just a second. But I see a few different questions have come up in the chat. So I'm actually going to share my screen again to answer those just quickly. So the first question from Jake is about the offsites. So it says, why are they excluded? But the offsites actually are already counted here. If you look across here, they're already counted in the depreciable basis. So hopefully that answers your question. And then Ron, you have two questions. Actually, I haven't read the second one, but oh, it looks like the second one's for DC and Ben. So Ben and DC, hopefully you can get ready for that question. But the first one is at the bottom of the depreciable residential column on page 2. So I'm going to scroll down. Keep your eye on this column, everybody, where my cursor is. Keep looking down here. Okay. You have listed some lender costs. Are these typically accepted by the auditors as depreciable costs? Well, that's a really good question, Ron. So the answer is yes, but you'll see here that just a portion of this particular project's costs are included in depreciable basis, and actually, therefore, they're going to be also included in eligible basis in this example. So not everything under the cost of issuance and financing fees section is included in depreciable basis, just a portion. And what's actually getting included here is costs that are associated with the construction loan. And just like we all know that construction loan interest is included in eligible basis and depreciable basis, a portion of the lender legal costs, lender expenses, origination fee, et cetera, does get included in eligible basis, typically to the same pro rata share that the construction loan interest gets included in basis. In this particular example, that amount is quite low. You can see here, for example, lender counsel, the cost is 50 grand, but the amount in the depreciable basis is just under 2.5 grand. And that's because the this is an AC rehab deal, and very little of the construction loan interest is getting included in eligible basis. That's a story for another day about why that is, but it's something specific to AC rehab deals. And then I think question 2, I see a few other questions. It looks like DC is answering Ron's question in the chat. DC or Ben, I'm not sure, do you want to weigh in on that one orally too, or just the chat?
I'm happy to talk about it if everybody wants to. It's something I'm going to actually bring up in my presentation. So if you want to wait for that, I can do that then too.
If you think you're going to cover it in the presentation, maybe we'll do that then.
Definitely.
Get moving. Okay, I'm going to hand it back to Dave. Thank you all for doing the exercise. Of course, afterwards, if you have questions on the exercise, you can reach out to any of us on the California Housing Partnership team, and we'll be happy to help answer those questions. Thank you.
All right. Apologies for taking a minute to work that out. Welcome back, everybody. I think at this point, we'll revisit the agenda here, and we are working our way into our third section, which is going to cover more CIDLAC specific questions and questions related to how to obtain an allocation of bonds. And so for that, I believe, DC, you are on for the next section.
All right, thank you for having me. So process with CIDLAC. First off, for anybody who doesn't know me, my name is DC Navarrete at CIDLAC. If you do know me, I've been around a while. I was at TCAC for quite a while, the San Diego Housing Commission, HC. So bounced around and have overlapped with a lot of you over the years. So for everybody else, good to see you. Everybody else, nice to meet you. So with our process, you're submitting to CIDLAC and TCAC at the same time. The bond issuer, so when you submit to us, we have a specific CIDLAC application. And in that case, the bond issuer is actually the applicant. Or on the TCAC side, the applicant is the developer, the LP, or whatever the group is that's going to ultimately own the property. And there's a lot of confusion on that when we get applications in, and that's one of the things we're working on to streamline and make it where it's just a little bit more specific in the application that everybody's used to. The TCAC e-app, I guess is what you call it. We call it attachment 40, but maybe have another section that lists specifically who the bond issuer is, who's the applicant, for the actual development, and then who the participants are. So that's something we're actually trying to clean up right now because it does become a little bit of an issue when we prep our resolution. So good to know that the bond issuer is in fact the applicant when you apply with us. We do the scoring and ranking. Reviews are done by both CIDLAC and TCAC staff. So it's a bit of a overlap. There's some redundancy in the reviews. We're working to also streamline that process, but the redundancies tend to help sometimes because if someone misses something or says, hey, this isn't there, someone else maybe found it. So not always a bad thing, but it is a little bit extra time and waiting on your part to see, because now that we're competitive, it's just like, it's like the 9% renter was waiting to see what happens. Do we get a letter? So we try not to slow that down too much, but it's with both of us doing the review as part of the process. Ultimately, we're responsible for that though. If you apply with us and you meet all the bond allocation requirements, the TCAC allocation, that's an automatic. It's over the counter for the 4%. It can be combined with state credits also. The state credit side that's TCAC controlled is 100% competitive. So back in the day, that wasn't competitive. It wasn't as much of an issue. And that was weird because that was competitive. CIDLAC wasn't. Now CIDLAC's competitive. But the bond sides or the 4% side still isn't, but the state credit side is. So there's like different layers of you meet this requirement, but maybe not for this, but maybe for this. And then last round, everybody saw when we ran out of credits in the third round, that was a little bit of a mess. So I'm going to address that also just a little later in the presentation. But so you know, the federal side of the tax credits is over the counter. Bonds are competitive. The state credits are competitive. So it's pretty much how it goes these days. Next slide, please. There's our mission statement. Takeaway from this group is that we are the people who do the bond side of the affordable housing. We do a lot of other stuff. If anyone's ever been in one of our marathon-ish type committee meetings, you know that there's a lot more we do. Some of it can be pretty contentious, some of it not, but it's all pretty interesting stuff. So if you ever do sit in on a meeting, there's a lot more we do besides affordable, but for the sake of this group, the affordable housing, the QRP program is what we're going to be talking about today. If you're interested in the regulations, which everybody is, there's a link for our website. The regs are they're in flux right now. They're in the process of being converted. Some of it was emergency, some of it was expiring emergency, some of it was permanent. We're going to make it one succinct set of regulations, and it's a little bit more involved in the TCAC side. So I'm going to get to that a little bit later also. Next slide, please. Those are all the chapters of said regulations. There's a whole lot of stuff there. Chapter 2 is the affordable component. It does read a lot like TCAC regs these days because almost our entire process has become competitive. The process has become competitive, and almost the entire scoring scheme is for this, for housing type, see the requirements under TCAC. For service amenities, you'll earn points as scored under TCAC. And it pretty much just loops back to what the TCAC requirements are. So for people well-versed in those programs, you really need to have both sets of regs up, I guess, unless you really know them. So you look at ours, it says to go to the TCAC one. TCAC regs will tell you exactly what you need to do to score, but we're actually the ones reviewing it, which really creates a lot of confusion because we're doing something someone else normally does. You're coming to us for it. So a little confusing, but we get it done. Next slide, please. This is a list of the volume cap for the year. So we're starting at about 4.3 billion. We're going to add about 63 million in carry forward that we know of right now. We subtracted 600 million for exempt facilities, and this is the amount we're left with. Is about 3.7 billion. Recycle bonds varies. There's a little bit of play there that someone might swap out for some recycle bonds to have more cap somewhere else. Could be that someone's allocation that they asked for includes some recycle bonds, so it's actually a lower number. There's just a couple pieces there that usually works out that we end up with more, but that definitely does vary. And it's not listed as part of the cap because we don't know what that number is going to be. So 3.7 is basically what we're working with. And in the next slide, if we want to jump ahead to that list where all that money is going. Broken up by percentages, very similar to TCAC. Difference here is our regions are a little different. We have the city, county of LA. We don't have San Francisco specific. Inland's a little bit broader, coastal's a little bit broader, northern's much broader. And then we have different set asides with our homeless ELI, VLI, mixed income, which is directly with Cali Chafe. And then, we have the BIPOC pool. They don't. We have stuff that's specific to preservation, other rehab. Rural is the same as theirs. But those are the breakdowns. The annual number, round one, round two. One thing of note was that the mixed income funds were front loaded to be all in the first round. So those may be exhausted pretty quickly. They just kind of front loaded and get it all out of the way. What's going to happen? There's been questions with if there's excess and it's not really enough to fund anything, what happens with that? I don't actually know the answer to that question. I think we're going to work out what happens. I think the committee will decide what to do with those funds, but stay tuned for that because that may be a thing. It was last year in the third round. So I would expect to see that to be a factor for round two at least. So be on the lookout for that. Also, the committee, I know last year, right before I got here, I think they made a change in round two where they adjusted the allocation. So I don't know if that's something that would happen again, but with our changes with that, and then I'll get into the regulation changes, timing of that, a lot of things may be subject to change for round two, but right now, these are the estimates we're working with. Yeah, so we're going to go into the pools and set asides. This is just a chart. Sorry, I'm going quickly here. I know we've been here a while. Trying to make sure I get all this stuff covered without losing all of you, because just like everybody else's sections, any one of these slides could probably be an entire day of presentation. So just trying to get through as much as we can here. So the bond cap split between the pools and the geographic. The geographic, again, a lot like TCAC. Our pools are different because it's split with the new construction, with the set asides with homeless, ELI, VLI, and mixed income. So you start there, a new construction in the set asides. If you're not successful there, you could bump to the regions. The BIPOC set aside pool, the BIPOC pool starts at BIPOC. You could be a BIPOC project that's homeless and qualifies for ELI, VLI, and you'd have 3 stabs before you went to the region. Or if you're a BIPOC that's rural, you'd be BIPOC, then slide to rural. There's just another step there, but it's a lot like the TCAC process, if you're familiar with that, where the higher up you are in the chain with which set asides or pools or targeting you qualify for, you have more stabs at getting funding. So it doesn't all start just, you're funded right in your area. That's the only hope we have. You do have a couple, cascades down. Other than rural doesn't really go anywhere else, nor do the rehabs. So if you're a new construction, you have a couple bites at it. So keep that in mind. Next slide, please. This is just a summary of the percentages that were in the chart a couple slides ago. It was rounded, but this is about what we have for the pools. So 60% of the allocation is to the pools. Those are the numbers. It's that slide even, and all that information is on our website. Also, find our contact info on the website if you want to get in touch with me for any of this information. Happy to share that. That's all readily available right there in the open for everybody to look at, so you can try to size and see what the competition is doing and how much money is left. So it's a good source for that. Also, again, I know new to everybody on this side the last couple of years because it never was a concern, but now all of a sudden it is. So that's fun. I think the next thing we have is a poll. Okay. So approximately what percentage of these polls are set aside for new construction projects?
Okay, we'll give it a few more seconds here. And we'll close it up.
Looks like 16 of you nailed it. So the answer is 75% on that. A couple slides back, it had it broken down as 25% to homeless, 30 to ELI, VLI, and 20 to mixed income. So that makes up 75% of the new construction pool. So good job, everybody. So for our purposes, rural is only for new construction. Rural at-risk preservation. So this is where you're in a certain time frame where your preservation may be lost. Same as with TCAC, it's no different than that. But the difference is we have other rehab that's its own specific pool of funds for someone that doesn't qualify for being at risk, but is also still some sort of a very important level of rehabilitation for a project, maybe converting market rate to affordable, whatever that might be, but it's a very important component. So it has its own specific pool of funding. So we do try to focus on that along with the at risk, which is just two separate things. They don't play together for competitive purposes. Oh, I'm sorry. I saw in the chat someone answered ELI, VLI, extremely low income, very low income. That's actually coming up pretty quick here. So we'll discuss what the components are of that and what makes it separate from the rest of the pools and funds available for everybody. So we'll get into that in just a second. So on this slide, we're just pointing out that projects funded in pools don't count towards the geographic regions. So that money gets pulled from that specific pool. The region's funds stay static. The only time that changes is when a project falls out of the pool, it goes into the region, then it could be competing against the regional projects. And if it's a project from one of the specific pools, it might be more competitive. It just sort of depends. So that's just something to keep in mind, but they don't go towards that cap. So if you're doing your own sort of sort, that's something to keep in mind, but I wouldn't recommend doing that. There's people that run a simulator. You can probably check that out instead. Save yourself the headache. Next slide, please. So we have the BIPOC pool. That's something new. So there's requirements for there. The point here with the BIPOC pool is it's looking for emerging developers. You know, people that maybe just don't have the experience, but have just enough to get maybe started, and that's about it. But they wouldn't have enough experience to compete against a fully experienced developer. That's what this pool is designed for. So you meet that requirement. There's also ways you could have full experience if you qualify as a BIPOC developer, but you earn that experience while working at another developer, and now you've left that developer, you can use that experience to earn points. There's quite a few ways to go about it. It's a little convoluted. We had a lot of funding for that last round, and then we should have a good amount this round, but I think there's probably some adjustments to be made to make sure that stays a popular option, and that it becomes a little bit more, concise, I guess is a good way to say it. I'll say easier, but a way that people can understand how they can compete, because there has been a lot of confusion around that. And last thing we want to do is cause confusion. We're trying to do something that would be helpful and beneficial for emerging developers, not confuse everybody and not want to use it. So working on that along with our regulation changes. It's a topic that's been brought up quite a few times, so be on the lookout for that. Next question, or next slide, please. So here's the pools, set asides. Currently, if you have to have a minimum of 25% as permanent supportive housing, and 100%, a priority goes to 100% permanent supportive housing in the homeless pool. So that's the current standard. There is a change coming on that. I'll get to that in a couple slides. More often than not, projects that apply as homeless end up qualifying as extremely low income, very low income. So that's a very, very common case. So I would say, because extremely low income, very low income has a section that requires, it's based on your opportunity area. I would say if you're homeless, you're probably going to qualify under the other ELI, VLI. Submit your stuff for the opportunity area. That way we just know it's automatically there. And if you slide down, then you're ready to compete there. We try to do that automatically, that we know homeless projects will get a stab at ELI, VLI, but if that information is missing, then we go through the deficiency process. And that just slows everything down for you. So it would be beneficial if you submitted that up front. Also, our joint application that we do doesn't really lay out which components you're applying for, if it's homeless or ELI, VLI. It's very, very confusing. And we know that. So that's one of the things I'm trying to get worked on to make it a little bit more straightforward, which group you're applying for, how you're applying for it, how you qualify for each one, and then what the information is that you've provided, showing that you qualify. So we're working on that for you also. And hopefully that will streamline things and eliminate a little bit of confusion going forward. Yeah, so here's the first thing. So for round 2 of 2022, so next round in July, the priority is going to split, drop from 100% to 49%. So that's a big, big change for the homeless set aside. The extremely low, very low income, the requirement there. So first, you have to have an average of average area median income of no more than 50% AMI. Second, you could have HCD funding. Third, if you don't have HCD funding, you have to have 15% of your project offset by public funds. And there's requirements, again, like I said, related to opportunity areas. And it's like, if you're a large family project in a certain opportunity area, then you're doing something. If you're in a low opportunity area, you're doing something else. If you're non-targeted housing type, you're doing something else. What it really, most of it boils down to is you're meeting 10 at 30 and 10 at 50 for your targeting. So 10% of the project would be at 30% AMI. Another 10 would be at 50%. That's pretty much what that's getting at, but there's some other variables there. And that's another thing we're trying to get cleaned up in the regulations, because there's an error there, and that gets confusing for people, but we're working on that one also. This is a good layout for what it is. Just remember that the opportunity area component does matter in this, so keep that in mind. And then for mixed income, so it's less than 50% restricted, and they receive MIP funding, so mixed income program funding from Cal HFA. And the bonds are only on the tax credit eligible units. And that did come into play once or twice last round, where people size things based on the entire project, and that messed with the their allocation limit per unit. So that's definitely something really important to keep in mind. Otherwise, it's a pretty straightforward program. It kind of runs itself. It's self-contained because it comes straight from Cal HFA and their pipeline, and they size it based on what we have available. So it's more getting through with them and then getting to us. So seems to work pretty well for so far. There's not a whole lot of issue there. Next slide. So this is going back to the idea of having other chances at funding. So BIPOC has the most, because there's the most opportunities. It's its own group. It could fall to any one of the other programs. It might slide to rural, could go anywhere else. BIPOC could be maybe an at-risk or another rehab. If it got funded from BIPOC, it wouldn't affect the at-risk or the rehab anywhere else. Just like we said, the pools don't. If it's funded from its pool, it doesn't affect the other pools or set aside. So keep that in mind. But the biggest takeaway from this is, again, the further up you are in the pools of set aside, the more opportunities you have at funding. And we know that our regulations outline it. There's been some question about why we do or don't list our, like, if people have a secondary pool, like again, homeless ELI, VLI. That's because we don't know if somebody truly qualifies. We don't want to list that until we do that review or have to do that review. It might get funded right out of homeless, and that doesn't ever come up. But it's safe to assume homeless would qualify for ELI, VLI. Otherwise, pretty much the rest of it's wide open. You don't know if it's going to qualify until it has to get to that level. But that's the big takeaway from here. The further up you are, the more opportunities you have. Next slide. This is the geographic apportionment. Again, one of the things I mentioned was last year, I guess right before round 2, they made some changes to the percentages, and we have regulation changes coming up. So there could be changes to this again. I don't really know how that's going to go. None of us do, but Again, one thing to note here is because of the way our regions work, coastal is a larger percentage than even the city of Los Angeles, which is the largest at TCAC. So it's not specifically in line with theirs. I don't know if that will be something that becomes aligned with theirs in the future, but that would be interesting if we did do that. I'm curious to see if that happens going forward. But for now, those are the breakdowns of where they are. There's always questions about maybe one area moving to a different region because it makes more sense, things like that. But this is how it is right now. And this is what it's going to be until we're told otherwise. So these are the regions. So now we're on to a case study. Let's see. So we're back on that Avenue Park apartment project. 24 units, large family, located in a high resource area, have special needs, has no post-ac home funding from HCD. So where should this compete?
Okay, we'll give this a few more seconds here. Alrighty, and we will close it now.
What does anyone else think of this before I say anything? I'm curious.
Talking to us panelists, DC.
Sure.
Yeah, I believe that most folks got this one right. You know, I again, I mean, it boils down to how you show it in the application, but correct me if I'm wrong, I think they're eligible in all these buckets.
Yeah.
So might as well take as many shots at it as you can, I think.
Yeah. I mean, if you came in the door and just said you were applying as homeless, we would cascade you through. But yeah, you get a bite at every one of those opportunities. The key there being that it's HCD funding, so you don't have to worry about the opportunity area in this specific project. If that was just public funds, you might not qualify for ELI just because what's required for the opportunity areas. So that's a little key factor there on the HCD funding. But that's a good question. I like that one.
Yeah. And so DC, we've got a question from the chat. Maybe I'll drop in right now. Do you know if there's any prognosis for getting more funds dedicated to re-syndications that's been discussed at the committee?
Not the last few meetings I've been to, no. There was questions, mostly what we've seen was around making sure there was funds carved out for rehab as opposed to at risk, and then the scoring on some of those, because rehab is an important component, but it doesn't quite score the way an at-risk project would or a new construction, so it's a different threshold. That's the extent I've seen on any conversation, but I would encourage anybody, if you want to bring that up, public comment for rate changes, I would absolutely do that.
Great, thank you.
As with everything with these, if you have any comments for public fund stuff or public funds for anything regulation related, please bring that up. We field a lot of that, and we're in the rate change. We're in a weird point with our rate change process, but we are in that process. So there's comments we can take and use somewhere. It might not be this exact moment, but we can use it somewhere for sure. Sorry, I wish I had a more direct question or answer on that, but it's sort of in flux right now. That's not something that's really been brought up. So for regulation updates, there have been some updates that have come through. So our manager here that kind of runs the select side at the staff level, she's working on making the regulations a little more succinct. There's a combination of the old permanent regs that have always been there, the emergency regs that were put in to make it competitive, and then emergency regs on top of that. And the big difference with us and TCAC is TCAC has the ability to write their regulation changes and they can get it filed. In our case, we have to go through the legal process with the state, and it's a very long process. So us to convert from emergency to permanent regulations, pretty big undertaking. This is something I didn't know when I worked at TCAC, but I learned this at HCD that it's a pretty big process. So for us to have to get all that stuff in line, we've been going back and forth with OL, trying to create one succinct set of regulations that will be permanent, that stuff everybody's been acting under. So we're not making really any changes other than clarifying and cleanup, but that's the first step. Once that step's done, there's already some changes in line. And then past that, we're going to be taking all those comments to make updates and revisions and improvements, because it doesn't make much sense to improve something on an emergency regulation that's going to expire if we don't make any sort of changes to it. And if you try to change that regulation mid-process from what it was, that becomes a whole other set of comments and process that really adds to the time, and those regulations might expire by then, and then we'd be on a different set of rules completely, and that would be pretty detrimental to the program. So we're just trying to get it uprighted, and then from there we'll make revisions and improvements. So sort of the process we're going on. Those regulations will be in place by round 2. And then there's the tiebreaker change is going to be in place for round 2. And then I want to just discuss kind of overall some other regulation changes, suggestions. Maybe if you want to throw some stuff in the comments, I would more recommend maybe sending in regulation changes. But if you want to use a sounding board or have some suggestions or anything, please, we could go over some of that too. So let's dive into this. So homeless threshold is likely to be reduced. It's dropping down to 49. That it was pretty well received by the committee. So I think there may be more to that. I don't really know, but is going to be reduced very likely, and maybe reduced even more. I'm not sure what's going to happen at that point, but that's definitely on topic for a lot of people. So one other thing we're looking for reg changes is a supplemental allocation process. We tried to be a little bit more open this round with ways people could apply supplemental. That's something that came up earlier. Someone asked about if you received an allocation a year ago, you're working along, you had huge cost run-ups. Now you need more bonds to be able to meet your tests, and you need like another $1 million. We have a lot of that this round. There's quite a few of them that came in, and it's under 2 things. One, it's under a pretty advantageous process. The tiebreaker is only based on what their current allocation is or the current request, and that really skews towards them being highly competitive. Now it's a small amount, so it doesn't really, they're asking for $20 million, but it does sway in their favor, and we're working on making adjustments to that to make sure levels the playing field a little bit. And then we're also working on a way to clean up that process to make it where maybe you don't need to submit a full application, but there's a whole lot of information we do need. So we want to make sure we get all of that from everybody, but save you the hassle of maybe submitting an entire application when we have a lot of it in-house already. And then we're also working on ways to address the state credit funding shortage issues. It's not something we have any jurisdiction over. We fund the project because it shows that it's feasible with the amount of bonds that we're issuing. TCAC does the state credit side, so there needs to be some coordination with them, and maybe some sort of a trigger that up to a certain threshold you'll get it, but you have a certain window to try to fill the gap. And if you can't fill the gap, then you could return the credit or the allocation. We have to figure something out on that, and that's something we'd be open to probably hearing from people about. But it was definitely an issue at the end of last round. I don't think it'll be as much of an issue this year, just because we have the 2 rounds and there's a little bit more time and we're not pushing up against the end of the year. So maybe it'll be a little bit smoother, but I still think just the shortage in general, there needs to be a better mechanism for us to check through that to make sure people can try to fill the gap. Because if there's a really small ask on state credits, it might be doable, as opposed to saying if you didn't get the award, you're not funded. There may be ways to make the funding work. So that's definitely something that's come up. Next, we'll talk about scoring. That's the scoring summary.
Yeah, DC, I'm sorry. I think Claire and I are gonna
Yep.
grab this next
Yep.
section.
Yep.
But if we manage to get anything wrong, or if you have further comments, please, please do weigh in.
Absolutely, yeah. I was just looking. It's like, yeah, I think it's where I tap out. So
Yeah. All right. Thank you very much, DC. Claire, you want to jump in?
Yeah, I'll go ahead and jump in. Thank you so much, DC, for all those regulation updates. I know a lot of people are on this call specifically for that information because they're curious about what's happening in round 2 and beyond. So, you know, as others have talked about on this call, SIDLAC, the competition is fierce, right? In a number of states, we have hit the bond volume cap, and California is one of those. And in all those states, they have to figure out a way in which to allocate the precious sort of bond resources that they have. So most states that have hit the bond volume cap have a competitive process with scoring, maybe even a tiebreaker in some instances. And then others like New York actually have a managed pipeline. So you just get in line. In California, we have a scoring system. And this scoring system is put together by SIDLAC, but with input from various stakeholders across the sort of affordable housing industry. And so you'll see in both the scoring and the tiebreaker, a little bit of a push and pull between these different concepts of what makes the best and what's the highest public benefit that we can get for these bonds. For some folks, it's what are the cheapest units that we can build so we can get the most number of units per bond dollar or partial units per bond dollar. And others think, okay, well, no, it should be more about you know, the richness of the programming, the deeper targeting. And so you'll see some push and pull in these in the scoring system and in the tiebreaker of different ways in which these two concepts are incorporated into how we allocate bonds in the state of California. So as shown here, we've got a potential total of 120 points. Many of you may know this already, but most projects are going to cap out at 119 points, except for large family deals in higher highest resource areas. So you may be thinking to yourself, oh, that's why my supervisor keeps talking about chasing those deals, those large family deals in higher highest resource areas. And that's because those deals automatically float to the top of the competition because they're able to achieve 120 points. Again, most other deals are going to cap out at 119 points. We are going to go through the scoring system a little bit, sort of briefly. What I share today is not going to be a substitute for going through the SIDLAC regulations on your own, going through the SIDLAC application, which has a really nice succinct summary of all the different options for meeting these scoring criteria. So do make sure you study this all on your own after the call. If we can go to the next slide, please. So some parts of the scoring system for SIDLAC actually align with the 9% program scoring, which is really wonderful. There's an effort nowadays to really align SIDLAC, TCAC, and HCD on some of the scoring criteria, some of the definitions for things like high quality transit, for things like site amenities, and I think we can all really appreciate that move. So some of the scoring criteria do follow the 9% program. For example, you know, the housing type definitions and methodologies, some of the site amenities scoring criteria, the same as the 9% program, site amenities, the general partner and management company experience, as well as the readiness. You can score up to 10 points for the site amenities, or sorry, I apologize, for service amenities. And then readiness scoring is like the 9% program. This is for closing your construction financing, actually issuing that notice to proceed within 180 days after you get your award. And so as we talked about before earlier in this call, that is a hard and fast deadline, and you are almost never going to get an exception or an extension to that. If we can go to the next slide, please. There are different scoring criteria for rehab deals versus new construction deals. You can imagine why. So there is a scoring criteria or criterion, I should say, just for the rehab projects, and that's the preservation priority section. And for new construction, they have scoring criteria for housing type and density and local initiatives. So this is really important to remember. I get this question from clients all the time. They say, hey, you know, I've got a new construction deal, but I want to know how I can get the preservation priorities score points. Well, you can't if you're new construction. Likewise, if you're rehab, you cannot get housing type or density and local initiative scoring points. I'm just looking at my notes. Okay, there are actually different ways to meet each of these different criteria. What I'll say is that, you know, again, today we're just kind of going over some of the broad elements of the scoring system, but you'll want to dive more deeply into the requirements. For example, in the housing type, you can either meet this by being a housing type that's defined under the TCAC requirements, or there are some ways that you can get this. For example, if you're fully entitled by January 1st, 2022, or if you meet some density requirements. So there are additional pathways to getting these points. If we can go to the next slide, please. So one of the big scoring criterions that folks talk about, criteria, I should say, is the affirmatively furthering fair housing. And so when we talk about the difference between the 119-point projects and the 120-point projects, this is what we're talking about. So large family or special needs deals in high or highest resource area are able to access a full 20 points in this category. And that's because traditionally in California, we've been building affordable housing in low resource areas or high segregation areas. And studies show that when we build housing in areas with high resources, and areas of high resources are those with good environmental health indicators, good schools, access to transit and jobs and amenities. When we build housing in those areas, we find that the life outcomes of the individuals living in those zip codes, those census tracts, is actually much better than the outcomes for folks that don't live in highest resource areas. And so CIDLAC, TCACs, or the state as a whole, and our industry generally, is hoping to incentivize some development, not all development, but some development in these highest resource areas. There's a link here on the right-hand side of the page. You can go to Belonging Institute at UC Berkeley and actually look at where these opportunity maps are in a bit more detail. You could actually look up where your own house is, or you can look up where your project is. One thing that's happened at CIDLAC that's under consideration is that we found that in a number of categories, a sort of lion's share of the bonds are ending up in these highest resource area districts, census tracts. And that's not necessarily a bad thing, right? Again, better life outcomes for folks who end up in these, that live in these areas and grow up in these areas. However, it's also detrimental to neighborhoods where we may want to see more development, areas that are, low or high segregation, poverty areas, low resource areas. We don't want to exclude development from there, right? Where development could be a good economic sort of injection into the community. And so what CIDLAC has been considering and what some advocates have been pushing for is having a soft cap on the 120-point projects, so that after 50% of the allocation in each of the pools has been made, that extra bonus, or not, I shouldn't say bonus point, but that 20th point turns off. So all of the projects become capped at 119 points, and then they can compete on the tiebreaker. That's just a proposal. Doesn't mean that it's necessarily going to happen, but it is on the table. You can only get these full 20 points again if you're a large family or special needs with 50% homeless units in a highest resource area. Otherwise, next slide, please. You can only get 19 points in the affirmatively furthering fair housing. You can get 9 points for exceeding minimum income restrictions and an additional 10 points for site amenities. Again, as this slide says, and the broker record that I am, please look at the regulations. Please look at that CIDLAC application, that if you actually download attachment 40, there's a tab for scoring that clearly lays out how all these, how you can meet the requirements for all of these criteria. And again, this is where the difference between the 119 points and the 120-point projects come into play, and why this affirmatively furthering fair housing is why developers in this current environment are scrambling to get projects in higher resource areas. If we go to the next slide, please. Okay, fabulous. These two scoring criteria are set up to incentivize projects to have deeper affordability and to be further below market rates than is required under TCAC. And they therefore are offering more benefits to tenants and more public benefits to all of us, the taxpayers. You can exceed minimum income restrictions is all about how you structure your AMI tier. So how you structure your affordability, whether you have 30% AMI units, 50% AMI units, 60% AMI units, or a mix. So you can have full points by having an average of 50% AMI or below, or an average of 60% AMI below, and 10% of the units at 30% AMI and 10% of the units at 50% AMI. You can get, oops, sorry, can you go back one? Wrong way. No. So funny, because that's exactly what happens to me. If you press the back arrow. Awesome, one more. Okay, thank you. The second criteria here is getting points for exceeding minimum rent restrictions. And that's, you get those points for how far below your rents are from market rate rents. So you may remember that TCAC requires that all rents be 10% below market at least, right? And that's not a problem in most places, but it can be a problem, especially sort of in the Central Valley, in more rural areas. You get maximum points if you have at least 20, if your units are at least 20% below market, and you get 1 point for every percentage point between 10 and 20% that you're below market. Next slide, please. The next scoring criteria is for cost containment and leveraging. This one, you know, as I mentioned at the beginning, there's sort of this push and pull between wanting to deliver strong public benefits associated with, you know, deep affordability, service amenities, site amenities on the site, and being cost effective with the state's dollars. And the cost containment and leveraging score really sort of hit at that idea, the second idea. So cost containment is based on how well you're sort of managing your costs. And it's based on for every 1% that you're below the adjusted threshold basis limits. If you remember from your TCAC study session, which you may have attended, you get up to 12 points. So if you hit 12%, if your actual development, if your actual eligible basis is 12% below your adjusted threshold basis limits, you get 12 points. And then similarly, you get points for leveraging other public funds in order to in your development. So if you have as much as 8% of your total development costs leveraged in soft sources as defined by TCAC, then you would score maximum points here. So the 12 points for being cost effective for cost containment and the 8 points for leveraging gets you the 20 points. Although you cap out at 20 points still, you would be able to double your points if you're less than 20. If you're in a large family or 50% homeless special needs development in a highest opportunity area, but you're still capped at 20 points total, right? So this would only help you if you're 10 points or less between these two different categories. That's how you get full points. Okay, next, please. So this is again the summary of the scoring. We kind of went through that quickly because it's a little bit late in the day, and I'm not sure how much you all are going to absorb from me just reading out loud to you. My recommendation is that you take a copy of the CIDLAC regulations and you download them. And then you download the attachment 40 from the TCAC website, go navigate over to the scoring tab and do a self-score analysis. Check out where your project lands on these. If you're getting 120 points, you're in really good shape. If you're getting 119 points, you're still in good shape, but you need to pay a lot more attention to the tiebreaker, which Dave is going to talk about next. And one last note on the scoring, DC discussed a little bit about the regulation changes proposed at CIDLAC. And we know that there are going to be changes to the tiebreaker and perhaps a couple of changes to how we allocate the bonds. But there shouldn't be any changes to the strict scoring rubric here. So anything that you have used in the past year should still apply. With that, I will pass it off. Actually, I think there might be a poll question. I apologize. Can you go to the next slide for the poll question, please? All right. This one should be an easy. I'm expecting a slam dunk. Everyone should be able to get this one right. What is the maximum number of points a project can obtain if it's not located in a higher highest resource area? Oh, I see a couple. Keep going. We'll maybe wait until it's been a whole minute. And there's definitely a curveball answer in here, which I will talk about in a second. All right, I think we've pretty much just about gotten there in terms of everyone's answers. So if we could please show the poll results to everyone. Okay, great. So it looks like 20 of you got it right, 119 points. That's the maximum you can get if you're not in a higher highest resource area. 120 points is the maximum you can get if you are in a higher highest resource area. And I'm wondering in the chat, does anyone know 109 points? We tried to throw you off the scent with that one. Does anyone know what the maximum score that is for, which program that's for? It's not the bonds. Can anyone guess in the chat? You get extra brownie points if you get it right. Maybe give people 15 seconds to answer. 109 points, maximum for which program? Maximum score. All right, I may have to say it. Okay, it's the TCAC 9% program. You can get a maximum of 109 points. So that was a little bit of a curveball. Okay, I think with that, I'll pass it on to Dave to go over the tiebreaker. Thank you.
Great, thank you so much, Claire. So we're getting to the end here. The tiebreaker has changed this round, and while it has not been officially adopted, we've got a pretty good idea of what it's going to look like. So there's a new formula that we're using here, which is essentially, the gist of it is that it's a level of public benefit that you're requesting divided by the level of resources, the level of public benefit that you're offering divided by the level of resources that you're requesting. There's an example in a little chart on the site at the link that's put below. Thanks, DC, for including that. And just as a sort of generic thing, public benefit is derived from 4 separate components. There's production, rent savings, population, and location, and the resources measured basically takes into account the tax exempt bonds and your state credit request that is further adjusted by a couple of factors. We'll get into that a little deeper here in just a minute. So on the, as we noted, it's public benefit divided by resources. And in contrast to the recent, tiebreakers for the last couple of years, you're no longer looking for a low score, you're looking for a high score. It's conceptually similar in that we're just basically trying to determine, what your project will give as opposed to what it will get, but we've kind of flipped the math on its head here. And so now you're looking for a high score rather than a low score. So for the public benefit, which is going to be the numerator of the equation. There are 4 major components. By far, I believe the biggest one is rent savings. So this is going to be weighted more heavily than the others. And it's effectively the difference between the fair market rents for your county minus your project gross rent limits. So this is basically just trying to measure, how much of a rent savings are you offering the tenants that live in the project as compared to market rate rents. The second component is going to be the production benefit, and this is basically just a bonus or a premium you get for each bedroom, and it's to account for differing costs for differing sizes of units. So, you know, it costs more to build a 3-bedroom unit than a 1-bedroom unit. You can house more people in a 3-bedroom unit. So we need to take that all into account. Give a little bit of credit to projects that are doing larger bedroom sizes. The third component is a population benefit, and this is just a premium for serving extremely low income or special needs populations. And the fourth benefit is a location benefit, and this is kind of a catch-all for a number of different factors. You know, primarily you're either going to get a bonus here if you've got a higher highest resource area. I guess there are some circumstances in which a moderate resource area can give you a bonus as well. And there's also sort of the transit amenities that you typically see in both TCAC and SIDLAC these days. You'll get a bonus if you score well, kind of in those amenities categories as well. So on the numerator, the denominator, we've got the resources measured. And this is pretty straightforward. It's tax exempt bonds plus the state low income housing tax credit requests. And, you know, DC can correct me if I'm wrong here, but I believe those are the two factors that are looked at because those are the two factors that are essentially under SIDLAC's control. The state low income housing tax credits are allocated by allocated by TCAC technically, but they are tied to the SIDLAC competition. So that's why those are the two components that are included there. And then there are further adjustments that are made if you've got a prevailing wage project, or if you've got I think it's type 1 or type 3 construction. So if you're doing a mid-rise or high-rise construction type that costs more to build, or if you're in a county that's got a high a high threshold basis limit, and you're going to have higher costs, you get a little bit of a bump there, and those factors are taken into account. So with all that in mind, I know it's getting late here, but we'll do one last poll. What can improve your SIDLAC tiebreaker? All right, we're getting pretty close to the end here. We'll leave it open for a few more seconds. Okay, and we'll close it up now. So most of you got it right. The answer is all of the above. The rent targeting is certainly, I can think probably the biggest component here on the numerator, and your state credit or bond requests are going to be important on the denominator. But all of these are factors in your scoring. So with that, we'll move on to timing, and I'll just briefly go over the program schedule. I think as we've discussed before, all the 4% applications will have a TCAC and SIDLAC joint application, whether you are requesting the enhanced state credits, which are from the special $500 million pool that's just come into play over the last few years, or if you're going for the quote unquote regular state credits, most notably if you've got a project that's not in a QCT or a DDA and you don't qualify for the 130% bonus, you can get state credits to backfill that gap. And so we've only got 2 rounds this year. And as you can see, the first round of both 9% and 4% have passed already. And so your last chance for 2022 is going to be application due on June 30th for 9% projects. And for this subject here, tax exempt bonds, it will be due on July 7th. And DC, I don't know if you're willing to weigh in on this or you have any insight at all, but do you think that they're going to go back to having multiple rounds, or more than 2 rounds rather, for residential projects in subsequent years?
I think so. Maybe once we get the regulations all aligned and have just a succinct set to work with and some way to address the state credit shortage. The big issue with the shortage was we were pushing up against the end of the year. And that was sort of a cutoff for a lot of other things and deadlines. It causes issues with carry forward if someone can't hang on to the credits or the allocation because of the lack of state credits. So if it was set up for proper timing and the regulations were in place, the changes were done in a regular rotation, something closer to TCAC, maybe even earlier than them, I think we could see 3 rounds. And I get why. I get the issues with readiness. And if I could have a second here, I did want to actually mention something about readiness.
Certainly. Yeah.
So our readiness requirement for the bond issuance, we have control over it being 180 or 194. Our regulations only, when they were written, only gave us authority for that component, not the readiness as the readiness to proceed component. We're working on getting that aligned. So your 180 or 194 on the bond issuance would match your readiness requirement, not be 2 separate deadlines, because that sort of defeats the purpose of having them staggered for your sake and for our sake. So that was sort of whatever the regs were done. That was one of the things that slipped through the cracks, or might have been intentional. I don't really know, but we're working on getting that aligned. So I think it's that would work better. And then the other component there to remember, though, is if you have state credits, you have to be on 180 day, because TCAC checks for readiness on state credits and they have no authority to change that from 180. It doesn't have that 180, 194 option like the other readiness stuff does. So that would be 180 no matter what. We're working on getting everything aligned more clarified in the regulations so that way people are not as confused, because it's pretty murky right now.
All right, great. Well, thank you very much, DC. So I believe that takes us to the end of our presentation. We've got some time left over if folks have questions. I saw one come through the chat with respect to whether or not this recording is going to be made available. I believe that it will be made available through the Whova app. I think that's how they handle this. So hopefully you'll be able to, hopefully you'll be able to access the recording there. Before we go, I think also conference evaluations are still being done. Correct me if I'm wrong. I hope so. Because we need your feedback to continue to improve this program. I believe those are done through Whova as well. So please, if you have the time, feel free to fill one of those out and let us know how we're doing. Does anybody have any other questions? We'll hang out for a little while longer just to make sure. All right. Seems like we're winding down here. So like we said at the beginning, if you've got any specific questions, feel free to reach out to us directly. I'd like to thank everybody, on the panel for presenting. It was a great job today. Appreciate your time and effort here. Thank you to everybody who attended, and also thank you very much to the conference organizers for putting this together and letting us be a part of it. So look forward to seeing everybody soon, and take care, everybody.